Good morning, everybody. Can you hear me, guys? Good morning, everybody. Can you hear me, guys? Am I audible? Am I visible properly? And I just welcome all of you to our fast track batch for November 23 CA Final SFM 100% in English. I'm not going to speak in Hindi because that's what we have promised to our students, okay, of South India, that I am not going to speak in Hindi, okay, because you are comfortable in English. So I think I should be able to do a lot of justice with respect to your time, because you are giving your very precious time just before the exams. Yes? Okay, great, great, great. Not a problem at all. So, I have given you the schedule, guys. Okay, in the previous batch of Hindi Fast Track, good morning, everybody. Yes, good morning, Akshay. Good morning, Athira, Siyad, Akshay, Vijaya, Sujit, everybody. All of you, a very good morning. Okay, so guys, let's not like waste too much of time talking here and there. We should be rather focusing on complete content because we cannot afford at all, because the exams are like kind of just on the door, and whatever time, 5 minutes, 10 minutes we have, I would try to make sure that you get 100% out of it. And what I would suggest to all of you is that you should be able to finish SFM along with me only. Don't keep it pending. Okay, maybe like the good part is that I could have done 2.5 hours daily the way we did for the Hindi fast track batch, but then I realized that if I do that like 2.5 3 hours daily, then it will go and it will be stressed into October, which I did not want. I wanted that you should be able to finish with the portion in September itself, and for that we have to ensure that we are taking longer lectures. I am sure you guys will cooperate with me and ask me doubts if you have. I am sure I should be able to help you out completely. So the Hindi batch has been a complete success. The students are happy. They've started studying and everything. The same, maybe more, I will try to do for you. Okay, thank you so much. Let's start. Okay, everybody, good morning. So the topic for today is valuation of bonds. Okay, let me start something like with I don't know how many of you are like, you have taken classes and everything. Some people would have done their self-study from on their own from here and there and everything. Okay, so what I am assuming that you need some kind of introduction about the subject and everything. You should know something about the paper. The first thing is that there are like almost like 10 topics in your CA Final SFM, kind of the practical part I'm talking. There are some topics which are 100% theory, like the financial and corporate strategy is a complete theory. Then securitization is a complete theory. Then startup finance is again a complete theory. Okay, I'm not saying that you cannot have sums on that, but on the basis of historical paper information, they have not given any question on those three topics. They ask questions on bonds, they ask questions on equity, they ask questions on forex, they ask questions on derivatives, that's futures and options. Then you have topic interest rate risk management, they ask questions on like swaps, and basically it is a part of derivative only. If you don't know, I don't know. Previously, interest rate risk management used to be a part of derivative only. Without studying derivatives, you cannot do interest rate risk management, and without doing these two topics, you cannot do risk management. Okay. Then you have portfolio management, you have mutual funds, you have mergers, right? I'm sure everybody knows that. Now what I'm trying to tell you is that there are topics like security analysis, security valuation. I'm giving you an intro with respect to the topic that we are going to start today. Okay, and in order to understand these topics, it is important that you should be knowing about the subject framework actually. Okay, so when I say security, what do you mean by that? It can be an equity, it can be a, I segregate securities into only two types: fixed income security and variable income security. So the fixed income security is like a bond, a debenture, an FD. It can be variable income like a floating rate bond or something. I'll talk in detail later on, not now. Okay, so when a company starts business, it needs money. And if it needs money, there are majorly two broad sources of getting money. One is equity and one is debt. What is the exact difference between the people who are investing money into a company in the form of equity or debt? The debt people, okay, the debt people are the risk averse people. They do not want to get that risk that is very much inherent in a business. Means whether your business is doing good or bad, whether you have money or not, I am not bothered. I need my money. That means periodical payment of interest. That period can be per annum, that period can be 6 months, that period can be 3 months, anything it can be. And there is a date on which this bond or debenture or fixed income security would be redeemed. But as far as equity is concerned, you cannot any income cannot be promised. If something is left after making payments to everybody, outsiders, okay, you will get something if the company decides, or maybe even if the company has money, it might decide not to give you money in the form of dividends. So that, and secondly, equity is a perpetual instrument. You cannot redeem an equity. If the company is listed, then what will happen? In a secondary market, the stocks can be bought and sold. The hands will change. The hands will change, but the equity cannot be redeemed. There can be some buybacks or something, but primarily the valuation model for these two instruments is one has got a limited maturity. Not that we do not have perpetual bonds, but at this point of time, broadly, we are assuming that bonds and debentures, or like a fixed income security, has got a finite life. There would be some day where this security would definitely be redeemed. So two unique features which can differentiate between equity and bond is: number one, finite life of a bond or a debenture; number two, the fixed income, that is a coupon part that we get, which cannot be there in case of equity, because equity people want to take that risk. Kind of one more thing, even if the company goes like for liquidation, okay, if the company goes for liquidation, the first right to get money, okay, will be of the fixed income security people. That's the bonds and debentures, people who have invested into the company in the form of debt. And that is why we say that equity has got more risk and fixed income security people are risk averse. And also, if the company does very well, I cannot ask for more share. I will only ask for the interest or the coupon that I owe, that the company owes to me. That's it. Guys, did you understand? Are you able to connect with me? Just keep talking to me. I like it, okay? I would be able to understand that all the students are getting the portion very well. So just tell me one thing. Are you able to connect? Are you getting everything what I'm trying to say? Is there something you want to change on my part with respect to like the speed part or something else? Just tell me, because this is the first lecture. So gradually we will settle down definitely. Okay. Good morning. Would you want me to reduce my speed or something, or all is fine? All is fine? Okay, great. So let me start with this proper formal topic. So they have given security analysis, security valuation, and they've also given corporate valuation. Okay. So when I talk about security, there can be only three types of security: a bond or a debenture, that is a fixed income security; number two, equity. Okay, and number three, hybrid securities. That means quasi instruments. That means a convertible debenture or convertible preference shares. Very good. Very good. Thank you, Harsha. Thank you. Okay, so I am not segregating the topics like security analysis and security valuation and corporate valuation. Believe me, once I am done with bonds and equity, all these three chapters are sorted for you. All these three chapters are primarily sorted for you. Okay, because usually you get a question on a bond or equity or a convertible. Basically, even in the convertible part, they have not given you very tough questions for that matter. They have given very straightforward question: and state value of a bond, conversion value of bond, and all that. They are very lame questions actually, very at a low level. They have not gone to a higher level of scale in terms of asking. There can be a valuation question in case of a convertible, which they have not asked at all till today. So you can relax on that part. Okay, so we are trying to start with bonds, and I think we should be able to finish this topic today only, because we do not have time further. Tomorrow we would be doing equity. So all set, I'm going to start here. Okay, the first topic, if you ask me something, if you see guys here, I've segregated the topic. See, if you do not understand the structure of the subject at all, if you do not understand the structure of the subject, you will not be able to do the sums. That means to say, when I say bond or equity, there would be so many topics for that matter. Okay, in any topic for that matter, if I say. But you should know what are the topics that you are supposed to study. I was telling to my students yesterday also that the lag time, the lag time between you read a question and you write a question, it should be 0. If you are prepared well, it should be 0, guys. Why? Okay, so basically, if you keep reading a question, okay, what is this, what is that, it's not a good idea in the paper, because you're wasting time. That is only possible. The lag time can be 0 only if you have done a lot of practice. That means there has to be some scientific way and logical way of preparing for the subject. Okay, now what I'm wanting to tell you is that if I divide the topic like valuation of bonds into if I provide a structure, I mean to say, the moment you see a question, you should be able to understand, okay, I have to start like this. Okay, otherwise you will keep reading and just trying to kind of look here and there that how should I start the question. That's again a very, very dangerous idea when you are writing a paper of CA final level. Not a good idea. So how I teach in the class is that I divide the whole topic depending on my research of 20 years of paper of SFM in terms of CA final. I just try to see that what are the topics that they have been covering over a period of time. Okay, and then I create a body. So the topics that you have to cover in CA final is like computing the value of a bond. Then we have types of yield measures like current yield, yield to maturity, and realized yield. Okay, then you have a third category, okay, like computing the duration and the modified duration of a bond, then interest rate anticipation and portfolio churning, then callable bond and puttable bond, then questions on bond refunding. Okay, so this is the kind of body. You need to have a list of the topics that they are going to ask in the paper. So those lists would be in the red, if you see here. Then the spot and the forward rates, okay, the bootstrapping questions and everything, computation of duration. So all these headings which you see are nothing but the broad structure of the topic that you have to prepare. That means to say, the moment you see a question in the paper, you should be able to know, okay, I know this question, because there is a particular way of starting the question. You cannot go random actually. Okay, then here, so I think you are able to understand what exactly I'm trying to tell you. So I would be writing a few things, many things I would be writing, and I would be like just telling verbally a few things. Okay, so what I can do for you is that let's create a group, okay, separate group for all the people who are attending lecture here in the 100% English batch. We have a group already for the Hindi people, but you should not join that group. Why? Because they are at a different level and you are at a different level. Not that you are you are not good and they are good. No, nothing like that. But then everybody would be talking similar. So you will get confused if you are there. Don't go there. I'll create a separate WhatsApp group for you and you can just join that. I'll share the link with all of you. Okay. So I'll put the link below this video in the comment box. All of you can join there with me, and the people who are attending this lecture, whether live or recorded, I don't mind that. Okay, start. So computing the fair value of the bond, something I should talk about valuation. Okay, two things rather I want to talk to keep it very simple. Number one, if you see your chapters, okay, bond, equity, hybrid securities, and then if you see like forex and derivative, everywhere you are trying to compute the should be value of that asset. Okay, that is the job of finance actually, everywhere. Why? Because there is something called a price which is quoted in the market, because that asset is being traded in the market. Okay, so how do I know that whether I should buy that asset? I'm saying asset. When I say asset, a bond can be an asset, an equity can be an asset, a foreign currency can be an asset, a future and option can be an asset, a merged company can be an asset, something of that sort. So every chapter, if you see, I'm sure all of you know, because all of you are at a certain level of preparation and you're going to appear for the examination, right? So if you will be able to like think on your own, value a bond, value equity, what should be the price rupee per dollar, the theoretical price of a future, the theoretical price of an option. Okay, what should be the value of a merged company? So everywhere you are trying to compute the intrinsic value, the should be value, the fundamental value, the fair value of that particular asset, so that you can decide whether to buy that asset or not. So that means to say, if you suppose, now you're going to answer me, suppose I compute the value of any asset, I mean to say intrinsic, and the value comes to 100. Okay, but when I go to the market, I see that that asset is being traded at 120. Tell me please, all of you, whether I should buy this asset or not. Yes, start interacting please. Yes, I should buy this asset or not. Suppose I compute the value 100, okay, and the actual value in the market is 120. Whether I should buy this asset or not. Tell me please. The actual price is greater than the should be value. No, it's not undervalued, it is overvalued. It is overvalued. Anybody else? It's overvalued, sweetheart. You maybe you thought opposite. If the price should be 100 only, and if the asset is quoting 120, should I buy? No, I should not buy. Yes, it is overvalued. Okay, so I'll tell you some rules to follow. No, we should not buy. Correct. So now guys here, kind of computing the fair value of the bond. That is our job actually. So you compute and then you decide, because see, should not buy. So whatever, kind of how good an asset would be, there has to be something called maximum worth of that asset. You just cannot go randomly and buy that asset. It is not allowed. And in order to do that, you need to do these calculations, compute the should be value. Overvalued. Arsha, it is overvalued. Can you remember one thumb rule? When actual price is greater than intrinsic value, the asset is overvalued. When the actual price, here 120 is greater than 100, the asset is overvalued and we should not buy. Why should we not buy? I'll tell you in 1 minute. Okay. Number 2. How do we value any asset? How do I decide whether I should buy this asset or not? On what basis valuation is being done? Correct. On what basis valuation should be done? The basis of valuation is, it depends on the cash flow generating ability of the asset. So the higher the cash flow generating ability of the asset, okay, higher will be the value. These two things you have to always remember. Number one, that we are wanting to compute the value of the asset before committing any funds, because I need to know what should be the maximum worth of this asset. Number 2, the worth that we are going to compute is based on the cash flow generating ability of the company. I'm sure guys you're comfortable. Correct? Going ahead. Now, computing the fair value of the bond. Let me start now. Correct. Very good. The value of the price of the bond is the present value of the expected future. And see, how do we define the definition? The value of any asset should be the present value of expected cash flows, okay, discounted at the required rate of return. That is the logic here. That is the logic here. That means higher the cash flows, higher should be the value. So higher the benefit I get out of the asset, higher will be the price that I would be ready to commit. It's a very simple logic. You don't need to know some like very hardcore complicated calculations for that. Not required at all. Okay, so it is written the value of the price, the value or the price of the bond is the present value of the expected coupons and redemption amount. So the definition, be careful guys, okay, the definition that I give you, is the price or the value. Please remember this for lifetime. Please remember the price or the value of any asset. Here that asset is bond. Okay, the price or value of that any asset is the present value of expected future cash flows. Cash flows is a very generic word. It's a very general word. So if I try to customize this definition in terms of a bond or a debenture, how would I say? The price or the value of a bond is the present value of the expected coupons and the redemption amount. That is what is written here. So the formula goes like this. Okay, the coupon into, so if I draw a timeline, maybe if I draw a timeline possibly like this. So 0, then 1, then 2, then 3, then 4 and 5. So suppose there is a bond which gives you coupon of 10 here, 10 here, 10 here, 10 here, 10 here, and it gets redeemed at 100. Okay. So this 10 looks like an annuity actually. This 10 looks like an annuity, this part. This part 10, 10, 5 times 10. So this will be 10 into PVA, present value of the annuity. Suppose I want to discount at the rate of 12%. So this will be your discounting factor. This R is your discounting factor, and you will substitute 5 there. Guys, do you understand the difference between the annuity and a single amount? So maybe like you can write down like this. 10 into PVA, okay, 12%, comma 5. Okay, and plus 100 divided by 1.12 raised to the power 5. So basically there are two types of cash flows here. One is an annuity and one is a lump sum, only single amount. I mean to say if I divide this into 2, 1, 2, 3, 4 and 5. I know all of you know this, but still I feel that somehow I am like, since I cannot see you, if I would have been able to see you, sorry. This is like, you know, this part, okay, this part will serve for this timeline, okay, this timeline, and this part will serve for this. I hope you are fine. All of you are fine, guys? All of you are good? Can I proceed further? Can I take an example here? Okay, now start. Consider a 2-year. I will just try to put more of time and you know, kind of explanation in the topics which are relatively difficult. Okay, these are something very simple, and just before one and a half or maybe 2 months before the exam, I assume that you already know. 1.5 only. Yes, guys? Consider a 2-year 1000 face value 10% coupon rate bond which pays coupon semi-annually. Correct? Now, yeah, I hope you understand that part. So let's not waste time, because then we will not get time to deal with the difficult topics. Correct? So, you know, kind of if I want to tell you something, let me show you something. Maybe like I take a new sheet for you, and where is that? Yeah, I'll tell you everything. I'll not miss out on anything for that matter. Okay, let's take one sheet here. So maybe like, you know, when I do the valuation, just see. I'll share the sheet with you in the group. So if you want to compute the value of the bond, let me write something. So there are different types of bonds actually. Different types of bond. Different types means a bond which pays coupon annually. Okay, so maybe like this. So maybe 0, then 1, then 2, then 3, then 4 and 5. So maybe 100. Let me write. You will understand exactly what I'm trying to tell you. 100 plus 1000, where this 1, 2, 3, 4, 5 are years. Okay, now B. A bond which pays coupon. A bond which pays coupon more than once in a year. Okay, so here guys, you know, kind of this will be like 100 into PVA. Okay, now suppose I take 12% comma 5 and plus 1000, okay, divided by 1.12 raised to the power 5. This will be the V0, correct? No, this 12%, this 12% and 5 are years. Now suppose for the same example, suppose I say that like semi-annual maybe. So this will be, this looks like this then. Okay, this is 0, then maybe like, you know, can I write here 1, 2, 3, 4, 5, 6, 7, 8, 9 and 10. So it will not be 100 every year. If it is suppose semi-annual bond, case 1, suppose I have given you a data. Suppose I say that the bond pays coupon annually, then this will be the timeline. This will be the timeline that you should be able to understand, correct? Then if I suppose say no, this bond is going to pay coupon semi-annually, then what should I write below every? This is not year now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 are not years. They are semesters now. So what will you do? It will be 50, 50. I will not write all of them, don't worry. This will be 50 and plus 1000. In this case, if you see, your V0 will get converted to 50 into PVA. Okay, if suppose 12% was per annum, so now this will be 6% per semester. So this will be 6% comma 10 and plus 1000 divided by 1.06 raised to the power 10. All of you are comfortable, guys? You can do the calculation later on. I am sure at this juncture of yours, you know how to calculate at least. So what I'm trying to say is that why should I like remember so many things? Why not do a few adjustments? So if a bond pays coupon, what I'm wanting to tell you is that when your payment periods are 6 months, I mean to say if this is 6 months, then the rate has to be accordingly adjusted. They have to be mathematically compatible. If your cash flows are standing at the end of 6 months, your rate should also be corresponding to that 6 month. So that adjustment has to be done. Now, if there are 5 years, okay, and the cash flows are coming every semester, then 10 cash flows of 50, 6% of the discounting factor, and number of periods will become now 10. That adjustment, if a bond pays coupon greater than once in a year, then your YTM or ROR will be R divided by M. Okay, coupon will be C by M, and maturity, okay, maturity, I don't know what to write, that's why I'm writing N into M, where M is nothing but frequency. So if you put this, you know, kind of, it is not easy. I tell you why. Because you might go wrong if you do not follow a rule there. Because suppose the question is given to you, so you know that it is a semi-annual. So ROR 12%, 12 by 2, where M stands for frequency. What is the frequency? Twice in a year. 12 by 2 will give you 6. Coupon 100 divided by 2, 50. Then maturity N into M, that means 5 years into 2, 10 semesters, and put that into the formula. So what will happen? You are objective. You are not imagining something. Okay, coming back again. So I told you now C would be a floating coupon bond. A floating coupon bond. Okay, so maybe like there are companies who issue bond, as you know that coupons are usually fixed, but there could be situations where the company has to issue a floating coupon bond. So how does that happen? The company will try to, like, you can say like this, the face value of a bond is 1000, okay, and the company benchmarks coupon to a standard index, okay, that is MIBOR, Mumbai Interbank Offered Rate, correct? Therefore the coupon per annum will be equal to M plus 200 BPS. Possible? Did you understand this part, the floating coupon part? Please tell me, did you understand this part? This coupon per annum will be MIBOR plus 200 BPS. So whatever is the MIBOR, at the beginning of the year, that would become your coupon. So usually this kind of bonds are issued in order to keep the investor marked to market. Because suppose if I buy the bond today and today's market interest rates are 10%, the company promises me 10% as coupon because the current rate is 10%. Nobody would give you more. I would not take less, but nobody would give you more also. But I am expecting that as an investor, that in the coming times the rates will change. So I want to be marked to market. That means whatever market rates are going on, I want to get that only. So if the company is in too much of need of money, if it is in dire need of money, then it can issue bonds which are marked to market. So whatever is the interest rate prevailing in the market, that would become your coupon. In that case, maybe like it will not be the fixed thing. So depending on the projections of the coming 5 years, the coupons would be decided. Okay. So 0, 1, 2, 3, 4 and 5. It can be 10%, maybe 10.5%. It can be 11%, then 12% and 12.5%. It can be possible very much depending on the MIBOR. But this 10, careful, this 10, oh God, this 10 is basically this one. So what if your face value is 1000, your cash flow will become 100. This will become 105, this will become 110, 120 and 125 and plus 1000. So I'm sure guys you know how to discount that. That should not be a problem. Again D. Then bonds which redeem in installments. So it is the valuation itself is not that simple. Depending on the variety of the cash flow pattern of a bond, the cash flows need to be decided. I'm not doing the calculations because I'm assuming that you know how to operate the calci. Or maybe when I'm done with this, we can just try to compute the answers for all of them. You can help me on that and we can just quickly write the answers so that we are done properly. Okay, redeem in installments, correct? So there would be a possibility that there is a bond like this, and 0, 1, 2, 3, 4 and 5 possible. It gives 100 here, it gives 100 here, it gives 100 here, it gives 100 here, and it gives 500 here, it gives 50 here and plus 500 here. This is what? This is basically if the bond is getting redeemed in installments. Okay, so here the bond is getting redeemed in 2 installments of 500 each. Did you not see one thing very carefully, guys? That, okay, that, did you focus on this? So if the company has already paid 500, you will receive coupon only on the outstanding principal, not on the whole amount. Okay, so you need to be very, very careful. Don't have to worry. Put everything on the timeline and you are sorted basically. Why do you imagine in your head? Just write down. Okay, that's how it works. Now, can you do the calculations for me quickly? Any one of you? I'll share this sheet with you in the group. Don't have to worry. Don't have to write. Maybe you can focus 100% on the lecture because I would be talking a bit fast because I want to cover a lot of portion in one lecture only. You can avoid writing. Okay, if you want to write, I don't mind at all. But you can focus on the reading part because I've shared all the sheets with the people in the Hindi batch also. Don't have to worry. Okay, because if you start writing, you will lose focus on what I'm speaking. Okay, can you give me the answers quickly? Okay, so 100 5 times. Yes, give me the answer for the first one. 100 into PVA, 12% comma 5 plus 1000 divided by 1.12 raised to the power 5. Do it quickly, guys, and give me the answer. Let me see how many of you are able to do correct. I'm sure everybody would be able to. Done? 927.89 is the answer. That's what they are saying. Is this answer correct, guys? 927.87 is the answer. Okay, they say, is this correct, all of you? Okay, so let's write down that. The answer to this is 927.87. Give me a second, please. Yes, it's correct. It's correct, all of you. Now give me the answer for this one, guys. Give me the answer for this one. (1.12) raised to the power 5 minus 1. $360.95. What is the answer for the second one? It should be slightly less than 927. That's what I feel. No, it cannot be. Harsha, it cannot be 604. It is not possible to be. You cannot get 604.5 and it is not possible. Please check your calculations. It cannot be. It will be slightly less than this thing. Where is the answer? 927. It will be slightly less because your data is almost same. Data is same. There is no change, no. It will be slightly less than 927. 926. I told you. I cannot. If I would have gotten time, I would have told you that why is it slightly less than 927. Okay, it will be very, very near. The gap can be bigger, understand, the gap would be bigger if the number of periods are more. That means if the bond was of 10 years, 20 years, 30 years, then this gap, okay, if you have two bonds with all the features are same except for one, that means the frequency of the coupon, the price cannot be too different with each other. The only difference is of compounding there. The only difference is because of compounding. Okay, it cannot be big. But I do not have time too much where I can tell you that why is there a gap, why the value would be slightly, and let me tell you one thing. If you convert this question into quarterly payments, do you want to do that? If you want to convert this bond into quarterly payments, okay, suppose, then the value will again be slightly lower than 926. The only difference, because these two bonds are completely same except for one feature, and that feature is the frequency of the coupon payment. Okay, so the only difference that is coming because of the compounding impact, no other change actually. The cash flows are not changing at all. Eventually both the people are getting 100 only at the end of the day in a year, but then one person is able to reinvest his cash flows 50 when he gets money on June 30th and he gets more. I don't know whether getting this or not. Should I tell you slight thing? So just see here. So maybe at t equal to 0, okay, you invest 1000, okay. After t equal to 6 months, okay, t equal to 6 months, you get maybe like 50. Okay, and then after this money will be reinvested. This 50 would be reinvested, okay, at the rate of 6% till December 31st. So 50 plus 6% will give you 53. Okay, and then t equal to 12 month, again you get 50. Okay, that becomes how much? 103. The only difference is that when the coupons are being paid annually, you get 100 at the end of the year. But if the bond is giving you coupon 6 monthly, you are not getting 100, you are getting 103. That means the effective return is 1.06 raised to the power 2 minus 1 into 100, and that is 1.06 into 1.06 minus 1 into 100. That is like 12.36%. Correct. Yeah, very good. So basically, kind of 12.36%. In that case, you were getting only 12%. When the coupon was being paid to you only annually, you were earning 12%. But when the coupon is being paid semi-annually, you are not earning 12, you're earning 12.36. Why? Because of the reinvestment of the coupon for 6 months, you get 103 and not 100 as coupon. Try to understand, okay? So the discounting is not happening at 12%. The discounting is happening at 12.36%. And that is why you are getting a value which is slightly lower than the previous answer. If you try to compute the same thing for a quarterly coupon paying bond, your effective rate will be more than 12.36, and that is why the value that you will get at by discounting quarterly coupon paying bond will be all the more lesser than 926, and the answer is 916 actually. Guys, did you understand all this? Did you understand all this? I did not speak all this in the last. See, I am a very spontaneous teacher. So it's a humble request to all the students that please do not compare the Hindi and the English batch. Please do not. The sheet is same. I have not changed the sheet for that matter only, and not needed also. But I am a very spontaneous teacher. I will not be able to stick to 100%. I don't even remember what I have taught there. So please do not compare at all. I mean, I do not know any one of them for that matter. My job is to sit and make the best out of time that they are giving to me. Okay? So, did you understand the logic? Pooja, did you understand the logic, sweetheart? The problem is the calcium now that I have, it does not calculate the GT thing. It does not have GT factor only. That is, I'm not able to compute the PV actually. I'm asking these students. Correct? No? Yes. You won't need so much of detailing, but still. Now coming back to the sheet again. Now this part is done. So if you see here, let's come back here. Consider a 2-year 1000 face value 10%. Please participate, all of you. Not there are only 2-3 people participating. Everybody has to participate, please. 10% coupon rate bond which pays coupon semi-annually. Find out the intrinsic value of the bond. The required rate of return is 14%. That becomes 7 actually. Compounded semi-annually. Should the bond be purchased at the current price of 965? Okay. Now I'm sure it looks easy to you. So here guys, 1000 coupon rate 10% and 14%. Some adjustments have to be done. So this becomes 50. ROR will become 7 and maturity 2 years, 4 semesters. Now it becomes easy. 50 into PVA, 7%, comma 4. Make it very mechanical. Don't try to, you cannot start learning in the examination hall. That has to be done before the exams and much before the exams, not even like now. The basic understanding has to be developed much before. We cannot do in the examination hall. Some people say, no, I need to understand. Oh yeah, got it. You need to understand, but not in the examination hall. The hands have to move like a machine in the examination hall. Barsha is saying quarterly is 925. Quarterly is 925.6. So what should be the, I tell you for the quarterly, the example that I gave you, if you want to calculate, I did not calculate the answer. Somebody wrote 916, I told 916. But it has to be lower than 926. That's my logic. What is that? I don't know, but it has to be lower than 926. So Barsha is saying that, ma'am, it is 925.6. Can somebody calculate, please? So if the bond is quarterly, just finish it off. Let's not like leave it in between. That's not a good idea. So coupon will be 100 divided by 4. That makes it to 25. Okay, then maturity will be, or N will be equal to, will be equal to 5 years into 4, 20. Okay, and ROR will be equal to 12% divided by 4. That is 3%, correct? So the equation will be like this. Okay, 25 into PVA, 3%, comma 20. Okay, and plus 1000 divided by 1.03 raised to the power 20. I do not know what this equation gives you. You need to calculate that. It is not a difficult calculation or something like that. Just we need to have a calci. And since I am wanting to move faster, 925. Okay, so I am writing here. Everybody, are you confirming the answer? Are you confirming the answer? 925.6. Let me check out on that. Give me a second. I'll confirm. Don't worry. So 1.03 raised to the power 20. Okay. Then minus 1. It's 0.8. 1.80. 80611. Again divided by 0.03. Okay. into 25, that gives me 371. Wait a minute, this should be 371.94 and plus, okay, again, so 1.03 raised to the power 20, okay, I get 1.80, okay, so 1 divided by 1.80611, I'm doing at my method, don't have to get worked up. 0.55 into 1000, I get 553 plus 371.94. 925 is the answer. 925 is the answer. Okay, this is 1000 into some factor. Okay, this will the answer is 925.616. Yes, correct. It has to be lower. I mean, see, there are some rules that we need to follow. It cannot go haywire. It is not possible. It's mathematics. Okay, so all are done here. All are done. Let's go ahead now. Now, this means if you buy the bond, what is the meaning? I always tell students that you should be focusing on that. What is the meaning of this answer? So how do you interpret that? This means that if we buy the bond at 932 and receive 50 for 4 semesters and redeem the bond at 1000 at the end of the second year, we shall be earning 14% per annum approximately. Why did I write approximately? Because it is actually not 14%. It will be greater than that. Since actual price is greater than intrinsic value, the bond is relatively overvalued and hence we should not buy the bond. Did you understand? I did not write 14% per annum because you are not earning 14% per annum. The way I calculated 10 point something when the bond is being, the coupon is being paid semi-annually. So similarly here 14%, you will earn 14% if the bond was giving you coupon per annum. The bond is not giving you coupon per annum, it is giving you coupon per semester. In that case, you are not earning 14%, you are definitely earning more than 14%, and because of that, the value that you get here, this one, we slightly lower than the value that you would have gotten if the same bond was compounded annually. Good morning, Nisha, you came again. Okay. Chalo, I am sure you are done. Types of, so guys, for the sake of giving you here, I've given you only one variety, but in the sheet I've given you 4 varieties, right? Now, types of the yield measure, do the calculation, but it is okay. Now, types of yield measure. So there are 3 yields that are associated to a bond, 3 types of yields that are associated with a bond. One is called current yield, then one is called yield to maturity, okay, and the last one is called realized yield. And each one of them is very different from each other. Very, very different. The purpose of each one of them is very different. That is actually biggest point that you need to understand. Current yield, first of all. Okay, so current yield is usually associated with a person who does not want to hold the bond for long. One very important point before I go ahead is that what? Whatever bond or debenture we are talking, they are all tradable bonds. We are not wanting, when I say fixed income security, okay, term loan is also fixed income. I am not wanting to compute the value of a term loan because it is not tradable in the market. You will only want to compute the value of an asset which is trading in the market. What is the point? Because any which ways, the value of a asset which is not traded, you cannot compare intrinsic value and actual value actually. So you are wanting to compute the value of an asset which is traded in the market, and hence in this chapter, at least in CA final curriculum, not that we do not want to compute the value of the non-tradable assets, but I have not seen in the CA final curriculum. So here, whatever bonds and debentures we are talking about, they are all traded in the market. Okay, please be very, very comfortable on that part. And when I say traded in the market, that means their values do get affected because of demand, supply, and many other factors for that matter. Now, current yield. Current yield is a yield measure where current yield is an yield measure which is usually like used by an investor who has got a very, very low investment horizon. Very low investment horizon. That means I just want to take one coupon and exit out of the system. Then you can use current yield. If you see the formula, you will understand on your own. Coupon by price. You tell me, is it possible to put more than one coupon here? It is not possible. If suppose the coupon is per annum, still you get per annum current yield, okay? But if the coupon is one semester, one quarter, you cannot put more than one coupon here. So basically guys, careful. I'm going to say something very, very important here. See, always try to understand that, very important point, that the price of the bond, and do you understand one thing, that this equation, in this equation, okay, your discounting factor, okay, can I not use this one? Normal time value of money I'm talking, okay? The discounting factor and the value are inversely related to each other. That means if you increase the discounting factor, this one, if you increase the discounting, let me remove everything, I made it too messy actually for you. Yeah. So if you try to understand, what I'm trying to tell you is that this will decide the value. Higher the discounting factor, lower will be the value. And this 12% is the required rate of return of the bond investor. So on what basis the bond investor decides that he wants to earn 12%? Do you think? Can you tell me? On what basis this guy, suppose I'm wanting to compute the value of this bond, this cannot change, this cannot change, this cannot change, and this cannot change. It is not possible because the issuer will not change. Once he has entered into the contract, if you entered into the contract with the bond issuer, okay, he will say, okay, you are going to get a coupon of 100 per annum for 5 years. So 105 and the bond would be redeemed at 1000 at the end of the 5th year. This data will not change. But the discounting factor is not of issuers. The discounting factor belongs to the investor. So he will decide what rate he wants to discount his cash flows. Okay, can you tell me on what basis he will decide it has to be 12, it has to be 10, or it has to be 13%? Can you please answer me? Please tell me on what basis he will decide it has to be 12, it has to be 10, it can be anything, right? So on what basis? For example, I am the issuer of the bond, you buy the bond, you will get 100 rupees per annum for 5 years and the bond will be redeemed at the end of the 5th year at 1000. But you want to discount and the bond is traded in the market. Okay, on what basis did you decide that you should discount the cash flows at 12%, not at 10, not at 11, not at 15? Why? Please answer me. Guys, I can promise you one thing. Once you have done this batch, you will be at a fairly good level. Don't have to worry about that at all. But you need to stick to the lectures. You cannot, like, you are watching sometime, you're not watching sometime, and to sit throughout the lecture, because my lectures would be very hardcore, tiring for you, because I speak a lot, I give a lot of information, power packed. So you should be, only if you sit continuously, you'll be able to like get it through. Once the topic is over, you will see that almost like most of the sums you'll be able to crack with logics. Nisha is saying something. Okay, the market prevailing interest rate, So tell me one thing, it is my opportunity cost. If somebody else is giving me 15%, why should I give you my money at 12%? Market prevailing interest rate for same asset class, for the kind of credit rating this bond has received from the credit rating agencies. Okay, there will be different rating bonds in the market. There would be different rated bonds in the market, correct? So depending, suppose my bond has got a rating of AA. So I will go and see another bond which has got a rating of AA, and similar in the industry of business where I am operating, I'll just try to see, okay, that company is into the same line of business as me and it has also got a credit rating of AA and it is yielding 12% for their bonds. I can use 12% to discount my bonds. Okay, so market prevailing interest rate, for example, for the kind of category of credit rating I belong as a company, okay, all the companies outside are giving 15%. Will you give money to me? No. Yes, opportunity cost, expectation of the investors, but based on similar risk class assets. Okay, I'm sure they got it. I'll not try to emphasize too much. Okay, so now please remember one thing, that this current yield that you get would be nothing but the prevailing rate of return in the market. You cannot stop here. There has to be a disclaimer around that. The market prevailing interest rate suitable to the particular bond we are talking about in terms of the credit rating, in the kind of business you are into, and many other factors. So the broad word would be similar risk class asset. I'm sure guys you got. The only thing is that you do not need maturity here. Be very, very careful. At times they would ask you compute the price of the bond, and they will not give you the maturity of the bond. You cannot use a present value model like this. Would you be able to use a present value model this way? Because if you do not have N, how do you use that? And they'll ask you compute the yield, or they can ask you compute the price. They will give you coupon, they will give you current yield, they will not give you the maturity. In that case, current yield will be the only formula that you can use to compute the price, guys. Okay, further, yield to maturity. This is something very interesting. If you understand yield to maturity, bond is sorted. There's only one topic that you need to understand in the valuation of bonds, and that is yield to maturity. 100% of the students, I'm sure, do not understand the way they should be getting this topic properly, because everything else flows from here only. So what is yield to maturity? Suppose I write V0 is equal to C into PVA R comma N, okay, plus redemption amount, the whole divided by 1 plus R raised to the power N. Okay, so suppose, understand, you have read capital budgeting, guys. You can be relaxed. We have 10-12 days in our hands. Okay, so take only to the extent where you are, till where you are able to. Here and there 1 or 2 lectures will not matter to you much, but the value add that I will be able to do in that time, okay, will be like a great. So do not like compromise. I don't want to compromise on the quality of the lectures at all. So maybe like, kind of after 4 hours you say, ma'am, we are not able to take it anymore. We can always take it to the next lecture, not a problem. But yeah, too much of backlog would not be appreciated, because that will create problems for you. My job is to sit here and teach. I can go for 5 more days, but for you those extra 5 days would be affecting a lot. So we don't want that to happen, and I would want, the way I've been able to complete my Hindi batch completely dot on time, I want to finish your batch also in time, so that you can plan your studies further. Okay, going further. So suppose there are 2 ways. Listen carefully, relax. There are 2 ways, no? For example, you have studied capital budgeting, correct? So suppose there is a project. I say this and you understand YTM. Give me a second. So suppose there is a project. Okay, so maybe the project is giving you a cash flows of 0, 1, 2, 3 and 4 year project. Okay, it gives a cash flows of 20 lakhs here, 50 lakhs here, 70 lakhs here, maybe 100 lakhs here. Possible? Now the initial outflow, how much should I take? 20 and 50, 70, 70, 70, 140, 140 and 100 is 240. I have to take it like 150 negative randomly. I didn't imagine anything. Okay, this is what is given to you. Okay, now if you compute the present value, if you compute the value, can anybody give me the suppose a KC, the cost of, let me complete the question. KC is suppose 10%. Possible? I am writing 10% because 10% factors are easy for me because I remember them. Okay, so maybe like 20 into 0.909, 50 into 0.826, then 70 into 0.751 and 100 into 0.683. Those are the discounting factors. Discount and get this 150. Subtract from 150 to get NPV. Okay, definitely I'm thinking that you'll get a positive NPV only, because that is how I've framed the question here. So suppose you get NPV as positive, you accept the project, and if the NPV is negative, you reject the project. That is one way of deciding. Okay, the another way of deciding is that you compute the IRR using these cash flows. That means 150 will be on the left hand side and 20, 50, 70, 100 would be on the right hand side. You compute IRR, that is the internal rate of return. If your internal rate of return is greater than 10%, then invest in the project. Yes or no? Yes or no? Pooja is saying that, ma'am, the NPV. Pooja, are you talking about NPV 30.39? Guys, if you do the calculations, it will become very easy for me, and you should do, because you are going to write the paper. Okay, if you do the calculations, because I will take time, no, if I speak and write, calculate both, then it will become like sluggish a bit. If you're quick on computing the answers, it will become very easy for all of us. Okay, 30.40, Vijaya is saying 30.40 is the NPV. Okay, so NPV is equal to 30.40, maybe I can take. But now I decide, okay, so at the cost of 10%, that means I am earning more than 10%. After paying my cost of 10% from wherever I borrowed 150, I am still getting 30.40 at my home. Correct? No? Now what I'm wanting to say is that if you compute the IRR of this cash flow pattern, if that IRR is greater than 10%, you will invest in the project, otherwise you will not invest in the project. And in this question, short I can say that you are going to get an IRR which is much greater than 10%. These are the two ways of a project appraisal, deciding whether I should invest in the project or not. These are the two ways actually. Similarly, when you compute V0, be careful, very important, somebody would not have told you ever in your life. V0 is something you compute, okay, intrinsic value. You compare that value with the price in the market, and then you decide whether to invest in the bond or not. One way of thinking, NPV method. How? Suppose you get 100 here, okay, and the actual price is your 100, and this 100 is nothing but outflow, because you will use this money. It cannot be 100, it has to be 120. Okay, outflow. Okay, now 100 minus 120 will give you minus 20. That means the NPV of this bond is negative, and hence I don't buy. This is one way of thinking. Okay, similarly what you can do, you can also compute the IRR the way I told you here, and that IRR in case of a bond will be called as yield to maturity, or YTM. All of you are good, guys? All of you are good? That IRR is nothing but YTM. Okay, YTM is yield to maturity, the rate which equates the present value of coupons and redemption amount with the cost of the bond. Okay, that is called the IRR of the bond. So here we compute the intrinsic value, compare with the actual price, and then decide by NPV method. The second way is that here I can substitute the actual price and then compute the R that I am getting. Okay, so maybe like if I put instead of V0, instead of computing V0, can I not put 120 in the answer, 120 in the answer, and then maybe 10 into PVA R comma 5 and plus 100 divided by 1 plus R raised to the power 5. Yeah, ma'am, all good. Okay, and then solve for R, that if I buy at 120, then what is the yield I'm going to get? That yield has to be definitely lower than your expectation, maybe, because the NPV has come negative. I'm sure you all have understood. So there are two ways of calculating YTM. One is this one. This is called shortcut method or approximation method. C plus F minus P by N, F plus P by 2. What is the meaning of this? So basically F is your redemption amount, P is the price at which you buy. Don't mug up the formula, not allowed. So C is the coupon per annum and F minus P is the capital gain. Capital gain can be only one, it cannot be multiple. But I divide it by N. Why? I divide it by N because coupon is per annum and the numerator has to be mathematically compatible. So when you divide F minus P by N, what happens, you know? You get capital gain per annum. Capital gain per annum divided by average investment. Okay, this formula is good. Okay, only thing is that you are ignoring the compounding part completely. But let me tell you, there would be two methods to calculate YTM. One is this method, which is called the shortcut or the approximation method. This method can be only used when the cash flows, the coupons are fixed. You cannot use this formula for floating rate coupon bond, okay, or maybe installment redemption bond. You cannot use this. It is not possible to use this formula. Common sense, right? So you will use this, you can rather not use, you can use this formula only when the coupon rate is fixed and the redemption is one shot. It cannot be in installments at all. Okay, the only drawback of this method is that it will ignore the compounding part. But the second method is what? This one. I already told you, this one. Okay, that means you will use a proper trial and error method to compute the IRR, and that IRR is nothing but the YTM of the bond. Okay, now see, I've written here the coupon must be fixed, the principal repayment should be one shot. Now there will be many questions, guys. There is a lot of doubt on this particular category because the ICI, I mean, everybody knows that they are not consistent in terms of their solution. That's the biggest problem that we face actually. So since they are not consistent in their solutions, what happens? We have to do like some imagination stuff, you know, that we have to use what. But I can give you some help on that part, is that if the question is 100% based on YTM only, that means whatever marks will be coming to you will be because of the solving the YTM, then go for the trial and error method, because you need to give them a proper method. You need to show them proper method. But if the YTM calculation is only a small part of a big sum and the coupons are fixed and redemption is one shot, then go for the shortcut method. Why? Because if the coupon rate is fixed and if the redemption is one shot, then whether you use this method or you use this method, the answer will be only slight difference would be there in the answers. That means using a shortcut method, you know, kind of in place of trial and error, where the coupon rate is fixed and redemption amount is like one shot, you are not committing any mistake or crime for that matter. The difference always would be to the extent of only some decimals, that's it. Then why should I spend my 15 minutes solving trial and error? Only if the question is based completely on YTM, then you are going to use a trial and error method. And yes, they are saying, ma'am, all good. Good. They are saying if either of the conditions are not met or both are not met, we cannot use shortcut method, rather we use trial and error method or IRR method. I think you're sorted on here. Here solving the YTM means solving R in the above equation. So a YTM indicates that the rate at which the present value of inflows from the bonds equates the outflow. Very good. Going further now. Ready guys, all of you? Okay, start. Let's start then. Today is the question, okay, the today being 1st January 2019, okay, Ram is considering to purchase an outstanding corporate bond having a face value of 1000 that was issued 1st January 2017, okay, that means 2 years are over basically, which has 9.5% annual coupon and 20 years of original maturity, maturing on 31st of December 2027, okay. Since the bond was issued, the interest rates have been downside and it has now selling at a premium of 125.75 per bond. Guys, this is only the premium component. Okay, determine the prevailing interest rate on the similar type of bond. Okay, if it is held till the maturity, which shall be at par. So basically, what I understand, guys, that it was issued on 1st of January 2017, which has 9.5%. Okay, annual coupon, 20 years of original maturity. Okay, I don't think the question is very difficult for that matter. Is it difficult or something? So 27 minus 2019. I'm only bothered with that. Guys, you know something? You will get very confused in this question with respect to the years actually. I tell you something. So if you do 2027, careful, huh? If you use your calci, 2027, okay, minus 2019 will give you 8 years. Can anybody tell me why? And why have they taken 9 here? Can you tell me please? Why have they taken 9 here instead of 8? Can you tell me please? It's a very simple common sense, but you need to tell me. So the number of, see, the valuation will start not from the original maturity, because that the years which have already gone are not relevant from the perspective of valuation. The logic is that the cash flows which are already happened are no more relevant to me. I'm not going to get those cash flows anymore. So I'll start my valuation, okay, where I am standing. So I'm standing on 1st of January 2019. Okay, so you are not going to bother about the cash flows which have happened before 1st January 2019. So can you tell me that the maturity is 2027 December, okay? So 2027 December minus 2019 gives me 8 years, but the sum takes 9 years, which is completely correct. So can you please tell me? because everybody is going to goof up. Or maybe you can just take a hint from here and you'll do the sum, but you need to understand the logic also. Very good, Harsha. Very good. Very, very good. No, Akshay. Very good. Harsha's answer is correct. See, if you see, 2027 is December. Okay, so 2019 December to December 2027 is equal to 8 years. But where are we standing? 1st of January 2019, and this extra 1 year is added. Okay, and this becomes 9. I'm sure all of you have understood what is the meaning of this, right? No? So since I think they are all sorted. So they are saying determine the prevailing interest on the similar type of bonds if it is held till maturity, which shall be at par. So guys, there is nothing in the question as such. Only simple calculation that you have to do is V0. They have calculated here 95 into PVFA. You have to calculate the YTM basically by the long cut method. YTM 9 and 1000. We could have solved with the help of like shortcut method. Should I try? Of course, they have taken a very long cut method, and you have to do. That was what I was trying to tell you. That if the question is such that it is wanting you to calculate only YTM, then you cannot use the shortcut method. You can use the shortcut method only to decide the start rate, that from where the interpolation starts. Okay, otherwise not, you cannot use that. So maybe if I want to use this shortcut method, suppose I want to use, it will be 95 plus 1000 minus 1125.75. Why? Because they said that the bond will be redeemed at a premium of 125. So premium plus face value divided by 9, the whole divided by 1000 plus 1125.75 divided by 2. Please give me the answer, somebody. Okay, so 1000 minus 1125.75 divided by 9 plus 95 gives me 81.03. Okay, so 1000 plus 1125.75 divided by 2. So was it 81.03, I think, and this is 1062.875. So 81.03 divided by 1062.875 into 100 will give me 7.62%. What is the answer here? Look at this. I took out with the help of the shortcut method. I told you 2 minutes back. I told you 2 minutes back that if your coupon is fixed and redemption is one shot, then whether you use the shortcut formula or you go for the long cut method, this one, okay, you are going to get approximately the same answer, not exactly, because methods are different. In this method you are considering compounding, in the shortcut you do not. So that is why, but the difference is what is the answer? My answer is 7.62% with the help of shortcut. So you can use this method only to understand from where should I start the discounting. So basically what you can do, I can tell you a very easy method. Why you have to do so much of calculation? I don't know why have they done. Should I give you the very shortcut method? Wait a minute. Just to give me a second, please. But you will calculate the values for me. Okay. Yes. Correct. We don't need only. So possibly can I, instead of writing so much, can I write like this? Okay. Now you can use this method. Again, I'm repeating, you can use this method in order to understand that what is the rate around which my IRR would lie. So you got an answer 7.62%. Your answer has to lie within 1% plus minus only. That is the maximum range that you will get, not more than that. It is not possible only. I am talking on the basis of my 26 years of experience in the subject. Okay, so don't worry about that. So at 7%, can I write here 95 into, please do the calculations for me, 95 into PVA, 7%, comma 9 okay, plus 1000 by 1.07 raised to the power 9. Can you tell me the value, please? Quickly. Quickly, please tell me the value. I can also calculate though. One 0.07 raised to the power 9 minus 1 divided by 1.84 divided by 0.07, okay, into 95 gives me 618.42, okay, then again 1.07 raised to the power 9, okay, 1.84, so 1 divided by 1.84 into 1000 gives me, okay, plus 543.47. I get 1161. I got 1161. Are you getting the same value? 1161.8, which is approximately the same. So I get 11. Let's do 62. Let's shorten it up. Now, what is the value that you want to get? It looks like this. Just look at the cash flows pattern. 0, 1, 2, 3, 4, 5, 6, 7, 8 and 9. Correct? So this is 95. Everywhere this is 95. What is happening? Yes. Give me a second, guys. I think my charge of the... Yeah, give me 2 seconds, please. When you can breathe, I can breathe. So again, I don't allow students to rest actually. So again, you will do the same calculation for at the rate of, like, did you see that you got 1162 approximately? How much you have to get? You have to get around 1125. You have to get around 1125. Just relax. 1125 is the price of the bond today. Okay. I took now 1125.75. Can you see that? So 1125.75 is on the LHS. If I discount at the rate of 7%, then I get 1162 in the RHS, right hand side. Okay. So since 1162 is greater than 1125, increase the discounting factor. Increase 7 to maybe 8%, or maybe, yeah, 8% would be good. Do it at 8%. Do the same calculation and tell me the value, please. At 8%, 95 into PVA, 8%, 9 plus 1000 divided by 1.08 raised to the power 9. Give me the value by the time I'm doing something. Okay, so this is like 95 everywhere. Okay, this is everywhere 95, and 95 plus 1000. Okay, and here guys, you are committing 1125.75. okay, this is the value. So 11, if I discount these cash flows at the rate of 7, I get 1162. How much you have to get? 1125.75. So at 8%, how much do you get? At 8%, how much do you get? So 95 into PVA, okay, 8%, 9, and plus 1000 divided by 1.08 raised to the power 9. Give me the value quickly. 1093. Okay, 1093.45. okay, so these are the two values that you have. This is 1 and this is the 1. So how do you interpolate? Okay, too many things to tell and too much of less of a time. So unknown rate minus lower rate. Which is lower if you compare 7 and 8? 7 divided by higher rate minus lower rate, and the corresponding values 1125.75 minus 1162, okay, and then again divided by 1093.45 and minus 1162. Solve for this R, you are going to get this only. So we do not need to write so much the amount they have written. Only 2 equations and 1 interpolating equation, and we are sorted. I mean, the question could come to my mind that whether they will give marks or not, but they should give. It is ultimately mathematics. Why should I write so much when I can do it in such a shortcut manner? 2 equations. I first took out the rate. okay, where an approximate rate from where my interpolation starts. At 7.62 is the answer that I got. So I understood that my answer would somewhere lie between 7 and 8. So when I discount at 7, I get 1162. I increase the rate because 1125 is lower than 1162. So if I increase the discounting factor, I get 1093. Interpolating answer, we are done. Next question, guys. Again, question number 3. Did you understand, all of you? Did you understand, all of you guys? All of you are fine? Okay, correct. So now the next question number 3. Considering the following data regarding the bonds issued by Neha Limited on March 15, 2003 to be redeemed on March 15, 2010, face value of the bond 100 issued at a discount of 10%, redeemable at a premium of 10%, interest payable semi-annually, current market price is given to you guys. Compute YTM, BEY and EAY. So always remember that if you have to compute the YTM for a bond whose frequency is where the frequency is lower, okay, where the frequency is lower, coupon payment, that means semi-annual bond or quarterly paying bond or something like that. In that case, guys, what I'm trying to say, these are the adjustments that you need to do. Can you see that? C by M. Okay, then F minus P, N into M. That means the numerator will be a cash flow corresponding only for the that particular semester basically, okay, and F plus P by 2, okay. This is per semester. You can never leave a rate, okay, where kind of you need to annualize and then only you can leave like that. Conventionally, traditionally, we can never leave a rate like that, 5.37% per semester or something per quarter. No, it is not the way. Even if you go to a bank and if you want to borrow some money, and if you ask the bank, even if you want to borrow for 3 months or 6 months, the rates would be quoted only for per annum. It will never be done. So never leave the answers like that. Now you need to annualize that. There are 2 methods to annualize that. One is a simple interest method, that is 5.37 into 2, because there are 2 semesters, and that is called BEY. What is BEY? Bond equivalent yield. Bond equivalent. That is, I think they gave this question only once in the lifetime. I have not seen a second time only. Bond equivalent yield. Okay. And the second is EAY. So here you are doing, do you remember, kind of there I told you that you need to analyze. So you are considering compounding part here. So 1.0537 raised to the power 2 minus 1. And that will give an answer of 11.03%. I do not know, suppose this kind of question comes. If they say BEY and EY, you are clear cut. There is a lot of clarity basically that in BEY it is simple interest method. In EAY it has to be annual compounded method. But suppose I only ask you YTM and do not ask you this and this. Can you leave the answer like this? 10.74, sorry, 5.37 per semester? No, you cannot. Even if they have not asked BEY and EAY, you have to do that. The students ask me, ma'am, which one should I do? Should I do BEY? I should do EAY. I cannot say do both of them. Do both of them, that would be better actually. Now the next one. Mr. X wants to invest 1 lakh in 7 years. Okay, now here 8% bond in the market, face value, which were issued 2 years ago. Okay, you are, that means only 5 years are left. That's what I can understand. You are requested to advise him what is the maximum price for the bond to be paid in the following scenarios. Guys, very, very simple question. If Mr. X is expecting minimum 9%, that means there is a cash flow pattern here. Can I write here? 0, 1, 2, 3, 4 and 5. And this is like 8, 8, 8, 8 and 108, correct? So you have to just compute the present value of these cash flows once at the rate of 9%, then at the rate of 7%, if at the rate of 8.25%, and then at the rate of 7.75%. I mean, you cannot get an easier question than this, what I understand. Okay, if the bonds are available, look at this. Can you see this? Can you see this? This is, if this is done, I mean, I don't prefer this one. I don't prefer this one. This one I would not prefer. I would want to go for a proper method because it will not even strike to your mind in the examination hall. So these are very, very normal calculations. Now, what they are saying is that, again, that is the important part. If the bonds are available at par, okay, if the bonds are available at par and 1% is the transaction cost, what is the effective yield? Okay, if the bonds are available at par and 1% is the transaction cost, that means my cost will become 101. Yes or no? Yes or no, guys? If the bonds are available at par, suppose, okay, that means to say the bond is available at 100. That also means that the yield in the market is 8%. Did you understand this sentence of mine? This line is so important. This line is so important. They are saying if the bonds are available at par, okay, what do you mean by that? If the bonds are available at par, that means at 100, that means coupon rate and your discounting factor or coupon rate or YTM or ROR are same. That is at 8% because only if you compound at the rate of 8% on the name of the coupon and discount, see, these are the coupons. If you discount them at 8 and 8%, you are going to get 100 here. So this is one of the bond properties. The bond properties, the first bond property says that the relationship between the bond price and the YTM is inverse in nature. What is YTM? The discounting factor. If you increase the discounting factor, the value of the bond will go down. See, why I tell you something. Be very careful. I want to tell you something, and that is, if the cash flows are like, just listen to me, how do I put it? Okay, so suppose there is a bond, okay, suppose the cash flows are 888 and 108 and the discounting factors are also 8%, okay, so what happens? I get 100, the value is 100. That means if I buy this bond at 100 and get 888 coupon, okay, and discount it at 8, I'm going to earn 8%. But suppose suddenly the market interest rate changes to 10%, then what will happen? Your 8 and 108 will not change, but the discounting factor will increase from 8 to 10%. In that scenario, you will not be happy earning 8%. Discounting factor is your rate of return. When the whole market is yielding 10%, would you be happy with 8? No, you will not be happy. So you cannot change that 88108 because the company has already issued the bond. If you want to increase your return from 8% to 10%, you'll have to push the price of the bond lower so that the capital gain component increases, and as a result of that, what will happen? That your returns will increase. Guys, let me tell you one thing, okay? If you're attending live, please do attend live properly, okay? Because it's a lot of effort teaching you. Don't go move to recorded. Maybe like we have not yet decided that whether we want to keep the lectures in the recorded mode after the video is over or not, because we already have one set of videos there already, okay? So please, this is something I am doing on a popular demand. This is something I'm doing on the popular demand. So people who have demanded should be sitting and attending the lecture, because it is I hope you understand that it is an effort to sit and teach. Correct now? So you need to be please there only. Please do not go away. It will discourage me somewhere. I hope you understand that part, right? Because this is the second time again I'm doing. And not something, I'm not obligating you or something. But if you attend, then only I also like it. Correct? Now, so what I'm trying to tell you is that I think you're sorted there. So 101 becomes my cost. Look at this. Where is that? Look at this. So effective yield, if the transaction cost is 1%, what is this? C by price. C by price into 100. So 8 by 101 into 100 is your yield. Look at this, 7.92%, because your transaction cost, you were getting 8%. You were getting 8%, correct? But because of the transaction cost that you paid 1, your cost increased from 100 to 101, and as a result of that, your yield went down from 8 to 7.92%. Okay, thank you, Harsha. Thank you so much. Okay, number of days required to break even. Careful. 2% is a transaction cost. Suppose they have given in the question. Okay, look at this. Find the number of days required to break even transaction cost if the bonds are available at par and 2% is the transaction cost. Okay, so 2% on 1 lakh. Look at this. Be careful. This is something you might forget actually. You might lose out on this. Rest all the steps are very, very manageable, and it is a latest question. 2% on 1 lakh, 2,000 rupees is your cost. They're asking how many days will you take to break even? How will you break even? What do you mean by breaking even? Breaking even means meeting this outflow with the help of the return that I'm going to get. So 8% on 1 lakh is my coupon. 8% on 1 lakh is my coupon. Divide by 360. That means earning per day. Can you not see? 1 lakh into 8%, 8,000 divide by 360 is 22.22. That means I am earning 22.22 rupees per day. So if I have incurred 2,000 rupees and if I am earning 22.22 per day, then how many days will I take to break even? They say 90 days and we are done. Correct? Again, now the next step that is going to come is a computation of duration and modified duration. Okay, so before I move ahead, I don't want to complicate you at this point of time. It is better that I keep concepts simple, because this is not the time wherein you are getting into the logic too much. We have to quickly revise so that you are able to attempt questions, and you should be very careful about the steps and the logic behind that, rather than getting into too much of detailing of the conceptual understanding. This is not the time where we are supposed to do that. Okay, but still, without telling you some part of it, we will not be able to solve questions. Now, what is duration and modified duration? Understand. Give me a second, please. So guys, what I say is that at 10:30 we can take a break. At 10:30 we can take a break of 15 minutes maybe. Correct now? Yeah, be there. It encourages me, kind of. I am ready to do the hard work, but people have to be there, kind of, because otherwise whom do I teach? Recorded is something it can, like, it's okay, but then when we are doing, so if the recorded part is there, then I can choose to record and just put it on the YouTube. I can just record, because then I am also like a bit getting some amount of flexibility. But if it is live, I have to be here for 5 hours. So if you are not there, then it will like, oh shit, whom do I teach like that? Yeah, so it's okay, that's okay. I was coming to the point. 10:30 we take a break of 15 minutes so that we can have our breakfast and everything and get a break also. Is it fine? And then again we start from there. We should try to finish this topic today only, as far as possible. We should not drag it to the next day, so that what you can do today only, after the lecture you can do some rest, and then what you can do, you can just pick up valuation of bonds, whatever classes questions you have. If you've done from me, then you have my book. If you've not done from me, you would have definitely gotten some book from the respected faculty. Okay, to try to finish bonds today only, just finish it off, and then again we start with equity. So maybe what will happen, in 10 days time you would be done with SFM completely along with me only. Yes, break at 10:30, Akshay. Yeah, okay, so 15 minutes break. So again we start at 10:45. You can have your breakfast and all that. Now let's start again. I'm fine. I just took a breather. Now what is duration? Now my this thing, kind of speed will get a bit slower actually. Okay, so give me a second, please. Okay, we are fine now. What is duration exactly? That you need to understand. So what happens if you talk about YTM? So what happens in the market? You already know that we are talking about bonds which are tradable in the market. Okay, now what happens, that I told you, I already gave you the introduction, that there are some things that you need to understand. There is a coupon, there is a redemption amount, there is a maturity. Okay, and just now 2 minutes back I told you that I can only control that price part, where price is dependent. Not even price part, I said it wrong actually, not exactly wrong. So basically that price, okay, is dependent on coupon, it is dependent on ROR or YTM, you can say. it is also dependent on redemption amount, and it is also dependent on the maturity, correct? Now what I'm trying to tell you is that this I can't control. I can't control this because the company has already issued the bond and the coupon is already fixed and it is written in the contract. That cannot be changed. Okay. Then ROR is something which is market will decide. I cannot decide that. I cannot control this also. I cannot control this also because it's, why can't I control? Because this is decided by the issuer. It cannot be changed. It cannot be changed at all. So basically, because of the change in this, this will change. Are you getting the point, guys? So what will happen? That if the YTM, if the interest rates in the market go up, the price will come down. Obviously, if I want to, I give you the example that suppose if the bond is the YTM and the coupon rate are at 8%, the price of the bond has to be 100 only, because basically you are going 10 steps ahead and coming 10 steps back. 10 steps ahead are coupons and 10 steps back are your discounting factor. So you land to 100 only, correct? Suppose the market interest rates changes from 8% to 10%, then your coupon will remain at 8, redemption will remain at 100 and maturity will remain at 5 only. But because of the discounting of the same cash flows, instead of 8 but 10%, okay, what will happen? The price of the bond will go down. It will be something lower than 100, okay, because I want to now earn 10%. I want to earn 10%, but with the given specifications and features, I cannot earn 10. Okay, so what can I do? The price of the bond has to go down. How much down? Till the time it starts giving me 10%, because it has to, you have to increase your capital gain component. You can earn, you know what are the sources of earning from a bond? Return of a bond. There are 3 sources, 1, 2, 3. Coupon, then capital gain, and then reinvestment. Reinvestment of coupons. You need to understand all this, otherwise duration is something you will not be able to understand at all. Now, return. So basically guys, what will happen, if you see the equation 8 by 1.08 and 8 by 1.08 whole square and 108 by 1.08 raised to the power 5, this is the equation, correct? So you know what, when I buy this bond, okay, when I buy this bond, what happens? I know that I am earning 8%, okay, but the moment I have not bought the bond till now, okay, suppose I am contemplating. When I buy this bond, I know if you calculate the YTM of this bond, because you are going to get 100 only here, if you compute the YTM of the bond, you are going to get 8% only. Now after some time, or maybe like during the day or maybe 2 days after, I find that the market rates have increased to 10%. So what will happen? The V0 will be 8 by 1.10 plus 8 by 1.10 whole square and 108 by 1.10 whole raised to the power 5. You understood? What will happen? The price will go down. So what happens when the market interest rates increase? When the market interest rate increase, you earn on the reinvestment of the coupons. What am I saying? I think you are not getting it only, maybe. Are you getting, guys, what I'm trying to say? Are you able to get what I'm trying to say? Because it is difficult to understand. It is difficult. Are you getting exactly, all of you are getting what I'm trying to say? If you are getting confused, then we can avoid this part completely and we can just go for the calculations, whatever method you have learned. I don't want to disturb you at this point of time. Please answer. Are you able to understand all this? You're able to understand? Oh, then I'm happy. Okay, great. So what I'm trying to tell you is this. Okay, then I would definitely tell you a few more things. Okay. So what I'm trying to tell you is this, is that this 8%, consists of all these three. Coupon, you are earning 8%. In 8%, you have coupon part, you have capital gain and reinvestment of coupons. So what happens when the market, actually two forces are working in the market. Two forces are working here actually. So when the market interest rates, so what do I mean to say when I say reinvestment? So basically it is like this. Look at this. So 0, 1, 2, 3, 4 and 5. Other people also, can you answer please? I have got an answer from Pooja, Akshay, Vijaya and Harsha. Other people, can you please tell me that I can see 20 people out there. Are you able to understand? So here is 8, 8, 8, 8 and 8. Now I think you will understand this time. So basically what happens, if the market ROR is 8% or YTM is 8%, then what will happen? 8, this will go here, this will go here, this will go here, this will go here. 8 into 1.08 raised to the power 4 and then it will come here again. So divide by 1.08 raised to the power 5. So if you see here, see this equation. See this equation. Can you see this? Can you see this equation? This one and this one. So if you cancel this 2, if you cancel this, what are you going to get? You will get 8 by 1.08, correct? This is what I'm trying to say. Again, the second one. The second one will be 8 into 1.08 raised to the power 3 and again 1 point. So basically, we are not able to see this. Why? Because when your reinvestment rate, I think you understand, yes, no? When the reinvestment rate, okay, in the numerator and the discounting rate in the denominator are same, then we do not need to write this lengthy stuff. We can go with this also, correct? Now, the point here is that, careful, when the market interest rate change, this 8 will now no more be reinvested at 8%, it will be reinvested at 10%, okay? But the discounting factor will remain at 8% only because that is your cost of capital actually, okay? So what happens when you bought the bond, careful, when you bought the bond, the coupon was 8%, my YTM was 8% because the market rate was 8%, okay, and the bond price was 100. Happy? So when I buy the bond, I am earning a return of 8% per annum. But you know what? You will be able to earn that 8% per annum for 5 years. What is 5 years? The maturity of the bond, only if certain conditions are fulfilled. Number 1, the market interest rate should not change in these 5 years at all. That means the yield curve needs to be flat. It cannot change. There are some disclaimers which are dangerous for us. And this is the study that is the actual study in the treasury management. Okay. So when I buy the bond, suppose if I buy this bond and if I hold this bond for 5 years, and disclaimer, okay, I need to hold the bond for 5 years, and also the market interest rate should remain at 8%. The coupon is not going to change any which ways. Okay, then only I shall be able to earn a return of 8% per annum till the day of maturity. Why am I saying that the market interest rate should remain at 8? So that my coupons should be reinvested at 8 only, and I should be able to get the upper wala part. Okay, but do you think it is possible? Even if I try to control those, even if, okay, I'm ready to remain invested for 5 years. Can you control the market interest rate? You cannot. You cannot. So what will happen? You know what will happen? No, in this case, this 8% will also change. Sorry. Okay. So in this case, this will also change. So basically, this rate 8 and 8 are placed at 2. Sorry guys, here both will change. That is the beauty. I just went to capital budgeting actually. Here it is not KC. So basically 8% is the numerator, 8% is the denominator. If the market interest rates increase to 10%, what will happen? You will earn more on the reinvestment part because now your coupons are getting reinvested at 10% rather than 8%. So you are earning more. Okay, so two opposite forces are working. But what will happen? The prices of the price will go down because your discounting will happen at 10%. So two opposite forces are working at one place. You are earning more, reinvestment income is more, because now your coupons would be reinvested at 10% instead of 8%, but the price of the bond will come down, the discounted value will come down, because now the discounting will not happen at 8, it will happen at 10. That is the problem. Okay, so in that case, guys, what will happen? If the increase from the reinvestment and the decrease from the fall in the price are same, okay, exactly same, then you will get 8% only per annum, complete offset. Okay, one is called reinvestment risk, the another one is called price risk. I tell you something. Understood? Yes? Yeah, MIRs in a way you can say. So now suppose I have a liability wherein I need to pay 8% every year. Listen carefully. There is a liability where I need to pay 8% every year. Okay. I want to buy this bond as an asset so that this bond will give me 8%. I pay to the liability 8%. Asset liability management. But that liability will not change. Every year I have to pay 8% for 5 years. That liability. I saw this bond in the market. Okay, good bond. This is giving me an YTM of 8%, but it is giving 8% now. Why? Because your YTM that you calculated is relevant for now. After 1 year, suppose the market interest rate changes from 8 to 10%, there is no guarantee that the bond will still yield 8%. It can give you more also. If your reinvestment income, so basically what will happen? In the numerator part, you are gaining. In the denominator part, you are losing. When the rates go up. So if the reinvestment income is greater than the loss that you incur on the price part, then obviously you will earn more than 8%. Okay, and suppose interest rates go down 7%, then what will happen? You will lose on the reinvestment part but gain on the price front, because your cash flows would be discounted at a lower rate. Okay, so in this case, if your loss on the reinvestment part is greater than the gain in the price part, I think you're getting the point. Okay, so basically, if you have seen a seesaw, when you were a child, you were sitting on a seesaw. So if a high weighted guy sits on one side and there's a low weighted guy on the other side, have you seen doing like this? You just try to shift a bit and try to balance the seesaw, right? So basically I want to tell you is that during the whole life of the bond, there is one point, one point of time in those 5 years where even if the interest rates change, the loss in the numerator and the gain in the denominator, or vice versa, offset each other completely, and that point is called duration. That means to say, if it is a 5-year bond, if you calculate the duration and it says 4 years, that means to say, it means that if you hold the bond not for 5 years but for 4 years, then even if the interest rate change after buying the bond, you should still be able to earn that 8% without change. That means that risk is called interest rate risk because it is applicable to the banks. Now you tell me whether if I'm wanting to create a liability where I have to pay 8%, the liability should be for 4 years or 5 years. Tell me quickly. So what is duration basically? Duration is that holding period during which the interest rate risk disappears. Can you, do you understand that part, guys? And if you do not want to understand, it's okay completely. We can just go ahead like that also, because it's not a time. 4 years, correct. So let's go ahead now. Let's go ahead. Let's do one question basically. And the method that we are going to use is called Macaulay's method. Okay, start. An investor recently purchased substantial number of 7 years. Okay, yeah. An investor has recently purchased substantial number of 7-year 6.75% thousand bond with 5% premium payable on maturity at a required volume of 9%. However, due to financial, this question was asked in May 23, what I understand, has got a proposal from another investor who is willing to purchase his bonds by shelling out maximum amount of 897 per bond. This question was asked in May 23, I feel. May 23 examination. They are asking you to calculate, determine the market price, duration and volatility of the bond. Correct, correct, always. Calculate expected market price. Let us not get into the detail. Just see how the question has been done. Market price. This you already know how to calculate. 6.75% into 1000 PVA or present value of annuity 9%, comma 7. They have given everything. Nothing like very complicated here. Then duration of the bond. How do you calculate? So basically I call this as X. The method that you are using is called Macaulay's method. Macaulay's method. Okay, so present value you calculate. This is your X, sorry, W. Give me a second, please. Okay, so this is like your weight. So basically what are we supposed to do is that you will calculate this, you will multiply this with this. So how do we do, you know what, how do we calculate? So this, you do not need to do such a complicated calculation at all. So how can you do year 1, 2, 3, 4, 5, 6 and 7. Then you have cash flow which is like 67.5, 67.5. Oh, give me a second please. So this is X, this is 1, 2, 3, 4, 5, 6 and 7. Then this is your, I hope you know how to calculate that duration. Should I leave this? Should I leave this? I'm sure everybody knows how to calculate that, right? I'm not wanting to teach you the method of computing the duration. This is shortcut. Don't use shortcut unless required. But yeah, you can use this. There is a question which was asked in the paper. You can use this when there are too many bonds for which you have to calculate the duration. Suppose, you know, kind of going further, you'll see that in one question they're asking to calculate duration 3 to 4 times. Then we cannot use this method. It is not possible to do that. Basically what you're supposed to do, you have years, you have cash flows, compute the present value of the cash flows, multiply WX. I'm telling you one thing, this and this has to be the same. Can you see that? Usually what happens, I tell the students that if a question has come, is asking you to calculate market price and duration both, then don't calculate the market price separately. Why? Because while calculating duration, any which ways you are going to calculate that. So this is a price. And then what are you supposed to do? You multiply X, WX, okay? So 61.898 into 1, 56.835 into 2 and so on. So you will get one column. This is XI and WI. WIXI, take the total of that, divide by 914, you will get the answer. The answer here is 5.758 years. It only means that to interpretation, yeah, I can leave the calculation part. The answer is 5.758 years. How do you interpret that? It means that if you hold the bond for not 9 years, but if you hold the bond for 5.758 years, then in that situation, you are immunized. That means even if the interest rates change in between, you are going to earn by default 9%. For example, even if the interest rate in the market become 11% or 15%, you are definitely going to earn 9% only. That means you are immunized. That means if you have built up a liability where you are supposed to pay 9% per annum, then you should build up a liability whose maturity is 5.758 years and not 9 years. That is the logic of this calculation. As per Macaulay, okay, as per Macaulay, duration is that holding period during which we are able to recover almost all our investment on a pro rata basis. That is the logic actually. Let's not get into that. It's not the time they were in 1.5 months before the exam, not a wise idea. Then volatility of the bond. So what is the volatility of the bond? So guys, you know what, I don't know whether all of you know this or not, that the bond, suppose this is interest rates, this is interest rate, and this is bond price, right? This is interest rate and this is bond price. Okay, so here guys, the relationship between the bond price and the interest rate is inverse in nature. Okay, not exactly like this, yeah, but yeah, like this. It is inverse in nature, correct now? So it means to say if the interest rates will go down, the bond price will go up and vice versa. So what I can do, what is volatility? If you draw a tangent to this, the slope of this is called modified duration. I can do that, Akshay, not a problem. I can do that. Modified duration. Okay, now, so how do you interpret that? It means to say, though if you do not understand this part, you will not be able to understand the convexity part also. It is not possible. You will not be able to understand the convexity part at all if you do not understand. I am thinking that it is a bit lengthy thing to make you explain or make you understand. But then I don't have a choice, because if I do not make you understand this, you will not be able to understand at all. Okay. So basically, there are two types of relationship. Okay, just see that. Linear. This is X and this is Y. Okay, so if X goes up by 1%, Y goes down by 2%, and if X goes down by 1%, Y goes up by 2%. What kind of relationship is that? Linear. Non-linear. Non-linear will be, okay, if X goes up by 1%, Y goes down by 2%, and if X goes down by 1%, then Y will go up by 2.5%. Did you understand the difference between the two? Can you understand? So basically the relationship between the interest rate, that means the YTM, and the bond price is non-linear. That means for every percentage change in the interest rate, the price of the bond, the change in the price of the bond is not same. And that is why the relationship is this one, a curve. Okay. But what we draw a tangent to this curve, and the slope of this curve is called modified duration. That means to say, though the relationship is non-linear between interest rate and bond price, okay, but for the sake of simplicity, we can drop the assumption of non-linearity, and we assume for the time being that, okay, for the time being, just forget that the relationship is a convex. Imagine that the relationship is a straight line like this. Okay, slope of this is called modified duration. If you are not able to get what do you mean with the help, what do you calculate with MD or modified? Just give me a second. So how do you calculate? Duration divided by 1 plus YTM. You got 5.28. You know what does it mean? It means that if the interest rate like this, look at this. It also means that, wait a minute, that if interest rate changes by 1%, okay, if the interest rate go up by 1%, the bond price will go down by 5.28%. I've written 2 just for the sake of it. It also means if interest rates, okay, if the interest rates go down by 1%, the bond price will go up by 5.28%. Please tell me one thing. Is the relationship actually linear, or we are just assuming for the sake of simplicity? Answer please. Answer please. Did you understand? Though the relationship is not linear, it is curvilinear actually. Okay. But for the sake of simplicity, for example, I have a bond. I just want to know that what will be the percentage change in the price of the bond for 1% change in the interest rate. Okay. I mean, it is a simple calculation. So it is also called as approximation method. You will understand, guys, if the people who are like holding on to the lecture will understand everything within an hour. Did you understand this part? So with the help of modified duration, what you can do, you calculate, like for example, 5.28 is the modified duration or the slope of the tangent. That means to say we are dropping the assumption of curvilinearity for the time being and assuming the fact that, okay, the percentage change in the bond price for 1% change in the interest rate is 5.28%. Guys, please reply. Did you understand this, guys? Yes, Akshay. Yes, yes. Means if the interest rate go up by 1%, the price of the bond has to come down. So, with the help of modified duration, you have made things simple. Though the relationship is actually not linear, but understood, no? Great. Now, so this means that if interest rate change by 100 bps or 1%, the price of the bond would change by 5.28% in the opposite direction. But let me tell you one thing, this is just you are ignoring convexity. Basically you are ignoring the fact that the relationship is actually convex or curvilinear. You are just assuming that it is inverse but linear for the sake of simplicity. Okay, now this also means that, so if interest rate increases by 75 bps, okay, the price of the bond should change by 3.96%. So if the rates increase, the current price of the bond minus 3.96%, or new YTM is 9.75. Guys, let me tell you one thing. If you draw a diagram here, you will understand in 2 minutes everything. Don't have to worry. Maybe like this. Okay. So maybe this is the price, suppose. Okay, this is the price. Maybe the rate was, this is interest rate and this is the price of the bond. Careful, give me 2 minutes only. Okay, so the price was 914. 914 was the price here, and the interest rate was how much? 9%, correct? This was the original situation. Now, suppose I compute the price. See, MD is the approximation method. Don't you remember that YTM can be calculated with the help of the shortcut method? So basically MD is a shortcut method, that okay, if the interest rate change by 75 bps, okay, 75 bps, the price should change by this thing. No. Yeah, correct, no? So 5.28 into 0.75. Why? Because 5.28 is for 100 bps or 1%. That comes to 3.96%. I did not do any calculation. I just wanted to know interest rates are increasing. Okay, the new price will be 914 minus 3.96%. Okay, the new price is 877.82. That means, guys, you are suppose allow me to write something which is graphically not too correct, but you will understand quite a lot. This is suppose 9.75%. Possible? And the price is suppose this one. So basically you are on the tangent. You will understand in 2 minutes what exactly is happening. You are on the tangent. Only during the break now it will be like sorted, I think. You will, if you do not understand, try to understand this, you will not be able to solve the question of convexity, and this time convexity question is important from examination perspective. You cannot ignore that part. Convexity is important from this exam perspective. Convexity, then bond refunding, they are important topics, and bond you have to do. So the rates increased to 9.75. So can you see one thing here? I wanted to show you that the price that you calculated with the help of what do you say? This MD. Okay, the volatility method is this one. And the price that you got is 877 point something. But you know what? That is not correct. Why? You got 877 because you assumed equal change in the price of the bond for 1% change in the interest rates. Equal change means if the interest rates go up by 1%, come down by 1%, the change in the price of the bond is same, and that is why you are on the tangent. But this is the proper method because this method will take care of the convexity also. And if you use this method, the new YTM will be 9.75%. Okay. So if you use this method, you know what? This is called what? Volatility method, and this is called repricing method. Okay. So repricing method is the actual proper method. So if you do this, is you are getting, give me a second, 938. 938. No, this is wrong, guys. Can you tell me the answer? This is wrong actually. It cannot be 938. It has to be around 877. Can you give me the answer for this particular equation quickly? Please give me the answer for this equation quickly, all of you. Please give me the answer for this. Somebody. It cannot be 938. It is not possible. Because already the rate is prices were 914 and the rates are going up. So any which ways it cannot be more than 914. Please give me the answer. 160 into PVA 9.75%, 7 plus 1000 into PVIF 9.75%, 7. The answer please. Somebody please give me the answer. Nobody is calculating, I think. So 1.0975 raised to the power 7, okay, minus 1, 1.918, 1.918 divided by 0.0975. I get into 160 will give me 785.37, 785.37, and then 1 divided by, guys, none of you are giving the answers. What happened to you? Are you there or not? Raised to the power. I need to go and out and get the calci actually. I have just missed out putting the calci in my table. Yeah, the coupon is correct only, na? No, the coupon is not correct. Coupon is not correct. No, coupon is not correct. Yes, yes. Coupon is not correct. It has to be like 6.75% of 1000. Wrong, guys. That was what I was also thinking. What is there? This is not correct. Yes, yes, correct, Harsha. Why didn't I register this? No, this is not correct. 6.75. No, that is wrong. That is wrong. That is wrong. Sorry, or a few that is wrong. The coupon is not correct. The coupon has to be 67.5. The coupon has to look at the question on the kind of the first part of the question. It is 67. It is a typing error basically, guys. That is a typing 67.5. So 1.0975 raised to the power 7, okay, minus 1 divided by by 0.918, 0.9, बताओ यार जल्दी. No, that is a wrong answer, Pooja. Your coupon is not like, what do you say? Coupon is not 160, it is 67.5. That was a typing error in the question actually. I did not also register. See, the coupon is 67.5. And the bond is also being redeemed at premium, I feel. Just check out on the question. The bond is redeemed on the premium. Look at the question, please. So this is the equation basically. See, you have to solve this. Wait a minute. So you have to solve, yeah, 67.5 into PV. Wait a minute, I'll just write down. 9.75%, okay, comma 7, 852, and plus 1050 divided by 1.0975, rest to the power 7. Is this correct now? Is this equation correct? 67.5 into PVA 9.75%, comma 7 plus 1050. This equation is completely wrong actually. This is wrong equation, complete wrong equation. This has to be how much? 852. Okay. So 852 is your answer. Can you not see that? Okay, great, great, great. So can you not see one thing here? Okay, let me take a different color. Let's take black. So guys, this part, there is a difference in the price, no? There is a difference in the, can you not see there is a difference in the price? It cannot be 852 also, it is wrong. It cannot be, it has to be more than, it has to be more than 877. It has to be more than, Pooja is saying 879. Can you check out on, the bond has been redeemed at premium of 50. So it can, and anyways it cannot be 877. Because if you see the graph, it is getting plotted above, that is logically, and calculation wise also, it cannot be, logic wise, what I understand convexity, it cannot be less than 877. It has to be more than that. 887. Vijay is saying 88. Okay, 878 you are getting. Fine. Let's write down 870. Slightly more, not much, but more. 878. Okay. Yes, Harsha, tell me. Okay, great. So now if you see this careful, when you try to compute the new price as per the modified duration method or estimated method, you got 877. And when you use the proper method, this is wrong completely, that wasted our 10 minutes. Yes. So if you use the proper repricing method, you are getting 878. So why there is a difference in the two method? We are computing the same thing. We are wanting to compute what will be the new price if the interest rates increase by 75 BPS. That means the current interest or the YTM or the ROR is 9. What will be the new price of the bond if the ROR or YTM becomes 9.75%? So when you use a shortcut method, you get 877 something, but when you use the proper method, you get 878. Okay. This difference is only because of the fact that in the first method, the MD method, you ignored the convexity part. The relationship between interest and bond price is definitely inverse in nature, but it is not linear in nature. That means for equal change in the interest rate, the change in the bond price is not same on the both sides. But when you use the proper method, it comes to 878. Anyways, always remember, whenever you are computing price using the proper method, that answer will be greater than the answer that you computed using MD method. And that is why I immediately said that your answer is wrong, because I did not calculate, but I knew on the basis of my past experience that it is not correct. Whatever answer you get, it has to be more than 877. And you know what? Going further, what is the difference? 1 rupee. That 1 rupee is because of the fact that you ignored that curve part. You assumed a straight line where it is not a straight line, it is a curved part. So, but you can tell me, ma'am, then that this calculation is wrong. No, it is not wrong. Till the time the interest rate changes are small. Can you see some area where both are this area? So when the interest rates rate changes, this side or this side are very small, like 10 BPS, 12 BPS, 25 BPS. Whether you compute the new price using the MD method or repricing method, they would be approximately the same. But when the interest rate changes are large on either sides, then definitely there would be a difference in the two answer. Okay, you know what you are going to calculate in convexity? That rupee 1. That rupee 1. So do you not agree with the fact that I can compute 877 using the MD method and adjust that component of convexity of 1 rupee and make it a proper answer? Yes or no? Yes or no, guys? I can use the shortcut method, the MD method, to compute the price of the bond. I come to the tangent, correct? And then I can use the calculation of convexity to compute that 1 rupee, adjust that 1 rupee to 877, and I reach to that curve. So that is the logic. It is difficult to teach in such a short amount of time, but still, I can still value add it to some extent. You will not be able to break these papers, whichever papers are coming at this point of time, you will not be able to break unless until you have a good conceptual clarity. It is not possible. It is because this question is like from the May 23 paper only, and it is not that straightforward. Understood now. Now they are saying required yield of the new investor. So guys, in the question, if you see, there is an investor who's wanting to pay, you know how much? He's wanting to pay 897. Abhi samjha. Okay, 897. So what would you do? You put 897 on the left hand side here. Okay, 897 you put here and solve and compute the IRR. I can take it like shortcut method also, 67.50, then plus 1050 minus 897, the whole divided by 7, the whole divided by 1050, 897 divided by 2. Take out the answer, please. So maybe 1050. Why did I do this? Because we are actually supposed to do the long cut method only. Then why am I doing this? Because if you do this, you will get to know from where the interpolation should start from. Minus 897 divided by 7, okay, and plus 67.5 will give you 89.35. So 89.36 rather divided by 1050 plus 897 divided by 2 will give you 973.5. Okay, so 89.36 divided by 973.5 into 100 will give you 9.18% is the answer. Okay, look at this. How much is the answer? Look at this, 9.39. I told you that if the coupon rate is fixed, if the coupon rates are fixed and redemption is one shot, then if you compute YTM using the shortcut method or using the long cut method, they would be approximately be the same. There would be only a difference of certain amount of decimals. That's it. Now the next topic, interest rate anticipation and portfolio churning. Guys, quickly what we can do, we can finish this question and take a break of 10-15 minutes. Okay, so we should take a break now, Pooja, or we should take break later on? When should we take a break? When should we take a break? Now? Okay, okay. So we can take a break, not a problem at all. We can definitely take a break, not an issue at all. There is a lot actually. It's okay. Yeah, we can take a break, Pooja, after this question. That would be better actually. Certain portion, because there is a lot of portion pending. I don't know how is it going. How are we going to cover? That's completely okay. But yeah, we should definitely finish the question first. This topic at least. Why am I getting a written sheet already? Not a problem. Give me a second, please. Okay. So it is easy. This is very easy. You don't have to worry about that. Everybody knows this question. So there is something called interest rate anticipation and portfolio churning. Okay. So what is this topic? As I told you that the relationship between 5 minutes, Pooja, 5 minutes. The relationship between interest rates and bond price. Akshay Vishnu, please send me the question. I do not know which question is that. I mean, cannot take out the question immediately. You need to send me the question. And see, we need to follow a certain kind of flow. I cannot take questions in between somewhere, because all the students have to get away. I can take questions only after I've completed the topic. I cannot take in between. I hope you understand that part. Because if the question is like not related to the topic, then the students will go haywire, right? So what I'm trying to tell you is that the relationship between interest rates and bond price is inverse in nature. All of you know that. If the interest rates go up, the price of the bond will come down. And if the interest rates go down, the price of the bonds will go up. This is the relationship that all of us know. This is called bond property. Now, one added property to this is that when the interest rates will go up, the prices of all the bonds will come down. When I say all the bonds, I mean to say the short maturity, the medium maturity, and the long maturity bonds. The prices of all of them will go down, but the long-term bond will lose more value in comparison to short-term bonds. Similarly, if the interest rates go down, the prices of all the bonds will go up, but the long-term bonds or the longer-term bonds will gain more value in comparison to short-term bonds. This is a property that you should know if you want to solve this question. Otherwise, you will not be able to solve this question. Okay, now, this property is exploited by the fund managers in order to make money, in order to avoid loss. How? Suppose you have 4 bonds. Okay, maturity, one bond is of 1 year maturity, the 1, 2, 3, 4. Okay, 1, 2, 3, 4, 4 bonds, 4 maturities. Fine. Now, I come to know that interest rates will go up. If the interest rates will go up, the prices of all the 4 bonds will go down, but the price of the 4th bond, the 4-year maturity bond, will lose more value in comparison to the bond which is only for 1 year. So what should you do ideally? You should sell off the 4-year bond and invest the proceeds in the shorter maturity bonds, basically, in order to avoid losses. Okay, for example, if 1-year bond loses 2 rupees, the 4-year bond possibly loses 10 rupees. So what you can do, you can sell off that bond and invest the proceeds in the 1-year bond. Therein, what are you doing? You are saving your 8 rupees. That is the logic. Similarly, if the interest rates go down, the prices of or the value of all the bonds will go up, but it will go up more for long maturity bonds. Naturally, same way. Not exactly, but yeah, if 1-year bond gains by 2 rupees, maybe the 4th-year bond will gain by 10 rupees. Then what should you do? You should sell off the 1-year or shorter maturity bonds and use the proceeds to buy the longer maturity bonds. This is called interest rate anticipation and portfolio churning, nothing else. Okay, now look at this. After this, you can take a break. Bond prices and interest rates have inverse relationship. If interest rates go up, the prices of the bonds go down, and when rates go down, the prices go up. An added property says that when rates go down, the prices of all the bonds will go up. I give you a choice to all of you. I give you a choice, guys. Now listen to me. I will give you a choice. Okay. Let me tell you a few things here. We already had an experience with this batch in Hindi that we took. Okay. So listen to me. It will help you actually. I will be, whatever you say, I will take a decision. I don't mind. So the choice given to you is that like there we did 2.5 hours daily in the evening. That was the schedule. Okay. So you can, instead of 5 hours, if you get too tired, instead of 5 hours, what we can do, that RTP, MTP lecture we did not take there, because the students said that, ma'am, you have covered enough actually. Okay, you have covered enough. We don't need to discuss RTP, MTPs now, because most of the questions that are difficult have been done by you in the class, in the fast track batch. So we did not do RTP, MTP. None of the students, the number of students was huge there. Okay, and all of them said, ma'am, we don't need. Even in the doubt solving part that I took yesterday, there were only 3-4 students who wanted to have doubts, because on a daily basis I am solving their doubts on the group only. So 3 lectures were saved for that matter. If you see your schedule, there is a 10-day schedule, okay, 7 days for the lecture and 3 days for the RTP, MTP and the doubts solving. So here also I assume that we would not be needing, the students are also less relatively, okay. So 3 days are saved any which ways for you. So if I take 10 days into counting, we are winding up on 28th of September. So if you think that you would get too tired with a 5 hours lecture, because whole topic has to be covered within one day, what we can do, we can make it part, like instead of 7 days, it can go up to 14 days. It will not affect you too much. Why I tell you? Because any which ways, if I reduce 28 days, 25th of September, we can wind up. If I go with the same schedule, okay? But if I increase the lecture, it will be 30th of September, but it will be 3 hours or 2.5 hours daily. 3 hours SFM, and then rest of the day you can study something else. So I am giving you a choice. If you want to avail that, we can go ahead like that. If it is too heavy for you, what do you say? Did you understand what I said? 10 days from here, 17 is 28th of September. But if I avoid RTP, MTP and doubt solving, which I am going to avoid, because in the last batch also, none of the students were interested in MTP, RTP and doubt solving, because during the lecture of 50 hours, everything was sorted for them and they wanted to study on their own. So if I avoid these 3, we would be able to wind up on 25th of September only, if I go for 5-6 hours daily. But if you think it is too much loaded content for you, what you can do, we can divide it into 2 parts. Instead of 7 days, we can make it to 14 days or 13 days maybe. So if I do that also, you'll be sorted by 30th of September. Tell me now, take a choice and tell me, because accordingly I will do then. Then if maybe like we can do the second part of the lecture tomorrow, I will change the schedule. It's okay, completely okay for me. Pooja is saying I'm comfortable with the whole. Try to maximize. If you think, see, it is important, whatever my lecture will be very heavy for you, because I talk non-stop. There are 20 people in the batch at this point of time. I can see. Guys, please tell me, how do you want it? Maybe we can do what, we can do like maybe like 7 to evening, maybe like 6 o'clock to something called like what, 6 to 8:39, something of that sort. I can do that, not a problem at all. Evening 6 to 9:30 we can do, or 6 to 10 we can. 6 to 10 is heavy. 6 to 9 we can do daily, and then also the portion will get over by 30th of September, because it's already 17. I get 14 days, I'll complete the portion. I will do that. I will do. Harsha, you will not get, sweetheart, you will not require for that, because the students only told me that, ma'am, don't do, all the questions are from the normal book or the study material only. But if you want, I can discuss that, not a problem at all. Only 2 girls are speaking, other boys are not, other people are not even speaking. Tell me please, guys. That will be easy on you, because going further after the break, you are going to have a very heavy portion. I don't know how many of you will be able to catch up with the portion. Haan, 3 hours daily will be better, because I can see you are tired. Athira, you spoke for the first time, sweetheart. Are you getting, Athira? Are you getting the portion, sweetheart? Now out of 18 people, I think South Indian boys are very shy or something. They don't speak. 3 hours daily will be better. That's what I feel. Yes, I will do the announcement today again. And because see, this is not easy. SFM is not easy. It's tough topic. Those people were able to handle, because we were doing 2.5, 8 to 10:30, 7:30 to 10, sorry. 7:30 to 10 daily in the evening we were doing. So they used to complete all their studies throughout the day, come here at 7:30 and do 7:30 to 10 daily, and they are done. 3 hours a day will be better. Second option is better. Okay. So can we do this topic now and just like three hours a day is better. Okay. So what time you want? What time? I give you 2 choices. One choice is 6 to 9 evening, and the other choice is 7:30, 7 to 10. One choice is 6 to 9 3 hours daily, because it is, I know it is heavy for you. It will be very heavy. See, it is not heavy at this point of time. Maybe like it is a bond equity, but then when I start forex and derivative, you will be like this. Oh my God. Oh my God. So maybe Athira, when you repeat these recordings again, uh, Athira, talk to me after the lecture. Talk to me after the lecture. I'll help you out. Don't worry. There are no people wanting to talk. There are no boys talking. 7 to 10. Okay, we can do 7 to 10. Not a problem. Other people we can reschedule, because see, I am deciding on the basis of the people who are talking in the batch. I am deciding on the basis of people talking in the batch. People who are not talking, you need to speak out. All the boys are quiet. 7 to 10. Pooja is saying 7 to 10. And you know what will happen if I take 3 hours now? You will not get worked up. Even I will not get worked up, because today I have a pressure of completing the topic. So maybe at times I also get worked up and you also get worked up. Okay, I have to complete the whole topic today only. When you get the breather, you understand better actually. And especially for people who are wanting to attend for the first time, it will be good. Okay, so should I take the further part tomorrow 7 to 10 in the evening? Are you fine with that? Should I take tomorrow? Complete this topic today. Okay, complete this topic today, and then remaining part what we can do tomorrow. What do you say? Today we can complete this sum and take a break. Okay, and we can continue this topic of bond tomorrow at 7 to 10 in the evening. Yes, very good, not a problem. I think more people will be able to attend if I do that. More people will be able to attend, I feel, because this is very core time. You can't sit on YouTube, attending the lectures. You feel very uncomfortable. Okay, I'm sitting. Yeah, nobody else is responding. I'll announce on the YouTube now today only that we have rescheduled, because people do not want to sit for longer hours. So we have rescheduled the lecture. Instead of 5 hours daily, we can have 3 hours daily and finish the portion max to max by 30th of September. I will not take it ahead, don't worry. Okay, so can we finish this question now and go ahead? We should finish this question now, go ahead and wind up for today. Tomorrow we are meeting again at 7 o'clock in the evening. Good to go. Achha, after break, can we take 1 hour? Okay, that sounds better actually for me. That sounds better. Okay, start. So I read this. Akshay. But Akshay, isn't it too dangerous for you, because you are attending fast track, super fast track of 30, 40, 50 hours, and that too for the first time? Are you able to cope up with my speed? Yes, we can do that. We can do that. Okay, sorted now. Sorted now, no change. Okay. So daily, daily, only guy who is speaking is Akshay. Daily 7 to 10 p.m. in the evening, Monday to Saturday. Monday to Saturday. We can avoid Sunday then. Okay. And Sunday, if you want to keep the lecture, we'll keep in the morning. Sunday we can keep in the morning. Sunday, can we keep at 8 to 11? We will have to do, guys, because we have lesser number of days. Okay, let me write again. So let's reschedule this, because I thought, but I just announced and it can be for them also. I changed, because only when the people are there, you are able to decide that what time they would be wanting to attend. So for the sake of starting, we started. Now we can settle down. So can we write Monday to Saturday? Monday to Saturday will be 7 to 10 p.m. and Sunday will be like 8 to 11 a.m. Correct. Great, great, great. Now sorted again. So let's start. Bond prices and interest rates have inverse relationship. Okay. If interest rates go up, prices of the bonds go down, and when rates go down, the prices go up. And added property says that when rates go down, okay, not a problem, Akshay. So when we do a group, you can ask me doubts, not a problem at all. Okay. If the interest rates go up, the prices of the bonds go down, and when the rates go down, the price go up. That is a bond property we already know. Why? Because when the interest rates will go up, the discounting factor will increase and the value will go down naturally. And added property says that when rates go down, the prices of all the bonds will go up, but they go up more for the longer maturity bonds. I explained you already. This is the only question which is given from their side in this category, guys. But all the students know how to solve this question. Every student of CA Final knows how to solve this question, but none of them actually know that what is the logic behind actually. Yeah, so let's decide that, Harsha. We can decide that later on, not a problem at all. Okay, now here the investment portfolio of a bank is as follows. Okay, now here guys, they have given a portfolio of bonds. So if you see, there are different maturity bonds, 6, 10, 15, 22 and 32. Okay, this is nothing but the year of maturity basically. So these are the coupon rates and face value is 100, and these are the prices of the bonds. Careful. And these are the duration already calculated. Again, to help you revise, duration during the whole life of the bond. If the bond is of 5 years, 10 years, 15 years, 20 years, what is duration? During the whole life of the bond, okay, there is one point of time like a seesaw where there is a balancing act. That means there is one point of time during the maturity of the bond where okay, the loss on the reinvestment part and the gain on the price part and vice versa gets offset with each other equally. And even if the interest rate change during this period, you would be receiving your original calculated YTM only. And that is why we say that we should not invest in a bond for the period of maturity. Rather, we should invest in a bond for the period of duration, because you are hedged from the interest rate risk. It's one logic. Okay, that is one interpretation of duration. Now that you have absorbed something, I want to speak more. The second interpretation of duration as per Macaulay says that, and the method that we use in SFM for CA Final or AFM for CA Final, whatever you call, is the Macaulay's method. You can ask me, ma'am, are there more methods to calculate duration? Yes, there are. But you are not supposed to study that. You are going to follow the method suggested by Macaulay. As per Macaulay, if you see the calculation, he says that duration is that holding period, okay, during which we are able to recover our investment done at t equal to 0 on a pro rata basis. So on that basis, can I say that okay, can you tell me, Akshay, this question goes to Akshay. If there are two bonds, one has got a maturity of like same, both of them have got the same maturity, 5 years, sorry. Both of them have got the, means every feature of both the bonds are same. The only difference is that bond A has got a coupon of 10 and bond B has got a coupon of 15. Which bond out of two, Akshay, will have a lower duration? Quickly. I'm just trying to motivate all the boys. None of the boys are speaking only. Other people can also answer, not a problem. Other people can also answer, it is okay. Just for the sake of it, I said Akshay, but then other people can also answer. I'm saying if there are two bonds with all the features are same, yes. Because as per Macaulay, duration is that holding period by which we recover all our investment. How? Coupons. Reinvestment income on coupons. Okay, so if the coupon is high, you will recover the cost faster. If the coupon base is high, the reinvestment income will also be very high. So you will be able to recover your, yes, yes, very good, all of you, very good. Now, here guys, what are they saying? Face value of the total investment is 5 crores in each bond. Face value of total investment is 5 crores in each bond. Okay. So 5 crore is the face value of the total face value and 100. So number of bonds will be 5 CR. Exactly. Second bond. Yes, yes. Divided by rupees 100. Correct? So basically 5 lakh bonds. Very good, all of you. Very good. 5 lakh bonds. Okay. So 5 lakh bonds in each bond, in each category actually. Okay. So this 2006, 10, 15, 22 and 32 are nothing but maturity. What is, calculate the actual investment in the portfolio. So if I multiply this 5 lakhs with their respective prices, correct Harsha, correct, reinvestment income, if the coupon rate is high, then what will happen? Coupon itself, the value would be high, and whatever you earn on that coupon because of reinvestment, that also will be high, and that will help you to recover the cost of the bond faster, as a result of which the duration will go down. You get questions of such kind actually in the paper. If you are not dealing along with concepts, you can get possibly 40, 45, 50, but if you want to score 80, 85 or something, or maybe below, above 60, not below 60, then you will have to be good on the concepts. You cannot avoid doing that. It's not allowed only. And it is not that difficult. It is just that you have to, like, I would not say right teacher or something that you have to decide, but then yeah, somebody teaching you with lots of concepts. You cannot break. See, till the time the papers were very easy, like 2 years, the papers of SFM were very, very easy. Let me tell you, 21 and 22, the papers were lame easy. Okay. The first time the paper came, 23, that was, it was not even tough. All the questions were there in my book, already there in the book. But then our students did well. They got 70 and all. So I do not know which attempt the paper will be tough. So our job is to prepare fullest possible level actually. Now, what is the suitable action to churn out investment portfolio? Sorry, calculate the actual investment in the portfolio. So 5 lakh into 106.5, 5 lakh into 105, 5 lakh into 105, because the number of bonds each category is 5 lakhs and the prices are given. So can you see that? You just multiply it and you get, this is your answer for the first part. 2637 lakhs is the actual value of the portfolio. Correct? Then what is the suitable action? This is what we were learning. To churn out investment portfolio in the following scenario. Interest rates are expected to lower by 25 BPS. Now you know that if the interest rates will go down, the value of all the bonds will go up. All the bonds, this and this. Okay, but you will gain highest, you will have the highest amount of gain in 2032, and the lowest amount of gain would be in 2006 bonds. Okay. So you know something, when I'm saying that when the interest rates will go down, the prices of all the bonds will go up. They will go up more for longer maturity bonds in comparison to short. Okay. So what should be the activity of the fund manager? He should try to sell. He should try to sell ideally 2006 and shift his money in 2032. Correct? Guys, this question cannot have one answer. Can I not shift to, can I not sell 6 and 10 and shift the money in 32? Can I not sell 6 and 10 and shift the money in 22 and 32? Can I not sell 6, 10 and 15 and shift the money in 32? Can I not sell 10 and 15 and shift the money in 22? There can be so many permutation and combinations, but you need to give just one combination to, and that would be sufficing your requirement of the institute. So ideally in a normal scenario, what would you suggest? Ma'am, sell 2006. You have to just give a reference answer that you know the concept. Sell 2006 and shift the money to 2032. That should be the ideal answer. But they have done this one. So many students ask me, why did you sell 2010? Why not 2006? My answer is because I say I did. So if I get the same question, my answer should not go wrong. Look at this now. Now, I have also computed the weighted average duration. So DP, duration of the portfolio, is summation of WI DI divided by summation of WI. What is WI? Weight. And what is weight? Weight is nothing but amount invested in each category. Okay. And what is a DI? DI is a duration of each bond. Why am I telling you this? Let's come to the question here. What is a suitable action to churn out the investment portfolio in the following scenario? Case 1, interest rates are expected to lower by 25 bps. Case 2, interest rates are expected. Guys, you don't have to focus on this amount. They are not, means 25 and 75 are irrelevant in this question. The only relevant part is the direction. Actually, you have to answer as per the direction. So also calculate the revised duration of the investment portfolio. Okay, revised means after the churning part. Okay, duration is already given to you. How do you calculate duration of the portfolio? Did you not say that my speed has settled down now the moment you told ma'am 3 hours daily? Otherwise I was also very worked up because I felt I have to complete the portion, like that. So thank you so much for that. It will be relatively less tiring for me as well. Okay, now here, so what did you do? I'm going to ask you one thing. Please answer, all of you. I would appreciate if everybody's answers here. Okay, that you're at a base level. There is a straight line. We are at the base level. This data, whatever is given to you, is a baseline, correct? Now they are saying if the interest rates go down, okay, suggest the churning part. If the interest rates go up, suggest the turning part, and then compute the duration of the portfolio. Okay, it will change naturally. Why will it change? It will change because when the interest rates will go down, okay, the prices of all the bonds will go up. It will go up more for the higher maturity bond. This is correct. Now, as a part of the portfolio churning, we would sell 2010. Why? Because ICI has done that. Okay, 2010. And what is the investment in 2010? The investment in 2010 is, you know how much? 525. This 525 is corresponding to 6.5. But when you sell 525, this 525 will now be getting a duration of 13. Correct? So naturally, the duration of the portfolio will change. It should increase ideally. What I like as a teacher, as a student, whatever you tell me, is that before I compute change, I always want to compute the current scenario, even if it is not mentioned in the question. Did you understand what I said? That means to say, any which ways, after churning 2 times, one when the rates go up, one when the rates go down, I have to compute the DP of the portfolio, duration of the portfolio. But I would want to compute the current DP, because first I need to know where am I standing, and from there the change can be calculated. Guys, do you understand what I'm trying to tell you? Could you relate with what I'm saying now? Please tell me on the chat box. Yes, correct na? Correct. Okay. So now look at this. So current duration I calculated. I did nothing, guys. I just multiplied with the amount and total, and this was divided by this. This is summation of WI DI, and this is summation of WI. Okay. So this is giving you the answer. 7. That means the current duration of the portfolio is 7.81 years. Now, if the interest rates lower by 25 bps, the prices of all the bonds will go up, but they will go up more for the longer maturity bonds. I already told. We can shift 2000 bonds, 6 bonds to 2032 bonds, and there are many more options available. You know what, while teaching, I'm teaching since now 16 years now. I would have taught like around 40,000 students in the face-to-face batch only. and so many pen drives. Okay, so now I am so accustomed to the questions that the students are going to ask me, that I write. I don't want any, because individually I have to answer them, so I write there everything. However, we follow the procedure followed by the practice manual. PM is practice manual. Once a sample would be to shift GOI 2010 to 32. Now, I don't know whether you understand this calculation or not. 20591, what is that? 20591 is nothing but WIDI. Now, when you eliminate 2010, this should be deducted. This I deducted here. See, 2 minus 3412. Okay, and then I added 525 with 13. So the amount 525 is here and here also. So the total amount doesn't change. So the duration will increase from 7.81 to 9.10 years. And similarly, you are going to solve the other part also. All of you guys, all of you, are you fine? Harsha, let's meet tomorrow only. Let's meet tomorrow. It's okay. I'll be able to finish the portion. Don't worry about that. Because see, again, I come after 15 minutes for half an hour. Doesn't make any sense. I hope you understand that part. Oh, thank you, Tanya, so much. Thank you so much. Thank you everybody. So guys, we can start tomorrow again. Is it fine? Because it's already around 11. If I take a break of 15 minutes, I come again. If you're wanting to sit for one more hour, then I come again. If you're not wanting, then we can continue tomorrow. It's okay. I will be able to finish by tomorrow. Quickly. That's so sweet of you. God bless you, Tanya. You made me emotional. You made me emotional, sweetheart. Yeah, let's take tomorrow. Not a point. Not a point coming again. Let's, Harsha, don't worry, sweetheart. Now that we have that batch also same happened. I was deciding. I decided to take 8 to 10:30, and then it happened 7 o'clock to 10 o'clock. One more hour you want to see it? Nabil, now he's saying now. One more hour? Okay, okay. So let's take a break. Let's take a break of 15 minutes. Okay. Let's take a break of 10 minutes maybe and come back. Sit one more hour and then only go. Make sense? Nabil, it is okay? Beta means, Nabil, you will learn beta. Beta means, you know what? Okay, good enough. So let's sit one more hour. Let's sit one more hour then. Okay, one more hour. Okay, so let's have a break now. Okay, let's have a break now and then we can come again. Okay, correct now? Yes, ma'am. Okay. So 10, it is 10:57. It is 10:57. What we can do? We can start at 11. You tell me what time should I start? Can we start at 11:10 or 11:15 maybe? So we will come at 11:15, sit till 12:15 and tomorrow again we can finish the topic. Not a problem at all. 11:15, yes. We come at 11:15, sit till 12:15 and then finish it off, and then tomorrow again evening 7 to 10 we finish off the topic. Makes sense. Because I think one whole topic of, like, it is a difficult topic. Going further, you are going to come across, like, kind of spot and forward rates, bootstrapping and everything, so many concepts, hard concepts. If you continue, you will not be able to get the it becomes a bit hard on you. I am fine, I am used to teaching 10 hours at a stretch, but then what is the point of loading you something which you are not able to understand? 11:15, yes, 11:15 to 12:15 we sit, and then again tomorrow 7 to 9:30, 10 o'clock, and we would be sorted very properly. That makes sense. So let's start. So let's meet after kind of at 11:15 quickly. Guys, come back after the breakfast at 11:15. I will be there only. Okay. Okay, are you there, guys, all of you? I'm already there. Give me a thumbs up if you're there. Give me a thumbs up if you're there. Should I start? Now I need a yes from all the 17, 18 people. I am not going to listen to them. All the people will give me a thumbs up there. Athira says, I can see Athira's answer. Harsha said, okay, thumbs up. Give me a thumbs up, all of you. Akshay said yes. Who else? Pooja and Pooja Mundra will be there. I know that. Only 5, 6 people are responding. Vijaya is there. Yes, ma'am. Okay. Okay, let's start then. Discounted securities. Okay, so this is one topic which is not directly given in your this thing. What do you say? Shruti is there. Shruti Shetty is there. Yes, ma'am. Very thank you, Shruti, for joining us. Okay, the discounted securities. Okay, now what is that? So, guys, this is a topic which is not given in your book module or somewhere directly, but there are lots of questions which are based on this. So I have written something extra which is not in your module, but if you understand, things will be much easier for you in the upcoming lectures or upcoming questions for that matter. So suppose I give you two choices. Suppose I am an issuer. Okay, I'm a company. You are the investor. So one way is that you give me 100 rupees and I give you 10% at the end of the year. That means if you give me 100, I give you 110. That is called add-on method. 10% on 100. Okay. So anything which is applied on the face value and that is given to you in the form of the interest is called add-on method. The second method is that you give me 90, I return you 100. This is called discounted method. If you tell me, ma'am, this is good, this is bad, no. It is just a mathematical method of computing return. Okay. Only thing is the calculation difference or method of calculation, nothing else. But then the behavior of things will change. The behavior of the securities will change. Okay, so now here we are going to understand a lot about discounted securities. Okay, so I've written here. There are two ways of computing yields on or returns. Add-on method, this I studied in CFA actually. When a security is issued with a basic denomination, that is face value, which is used for computing coupon pay amount, is called add-on method. A coupon paying bond or debenture. I'm sure everybody understands that. Discounted method, when a security is issued much below its price and redeemed at par, it is called discounted method. The difference between issue price and face value is an interest component. Example, a treasury bill or a zero coupon bond, ZCB. The discounted securities can be segregated into two categories on the basis of their maturities. Okay, so basically now we are not talking in this whole topic starting from here till the time I finish my spot and forward rates and bootstrapping. I am talking only about discounted securities, guys. That is what I told you when I started the lecture. It is very important that there has to be a structure in your mind. The moment you see a question like T-bill, you should know that a T-bill is always issued at discount and redeemed at par. A zero coupon bond is always issued at discount and redeemed at par. But what is the difference between a T-bill and ZCB? There is a difference. A treasury bill is always issued for a maturity for a year or less. It will never be issued for a maturity greater than 1 year. Okay, whereas a zero coupon bond will always be issued for a maturity of 1 year or more. So there would be a difference of compounding, actually, nothing else. So I have again, the discounted securities can be segregated into two categories on the basis of their maturity, less than or maximum 1 year. There are a few securities like treasury bill, then there are commercial papers and all that. Don't you remember computing RF, risk-free rate of return? So for example, Okay, so whenever kind of they give you questions like, how do I say, like, let me tell you a few more things. I feel I'm not wanting to keep some knowledge to myself only. I am wanting actually not to talk more, because then the discussion starts from there again. So but still I think I cannot compromise on that part. So all enterprises need money. Both of them need money for short term, for their working capital requirement, and for their long term, for projects, correct? So government is also an enterprise. They also need money for long term and short term both. So for the long term, they issue zero coupon bonds for a dam, or for a metro, or for a highway, or a roads, or many industries also. They also need money to meet their working capital requirements, and they meet this requirement with the help of a treasury bill, T-bills. T-bills are issued for 91 days, 184 days, and 364 days. Okay. So who will issue? RBI will issue treasury bills in the market on behalf of the government of India. I'm talking of India at this point of time. Okay. These treasury bills are invested by mostly banks, because it is compulsory for them to invest in the statutory liquidity requirement, SLR requirement, CRR and SLR requirements. Okay, I'm not getting into that. So they are called money market instruments. They can give you a data of a treasury bill. For example, they can say a treasury bill is trading at a price of ₹95, and it will be redeemed after 184 days. So how will you calculate the yield, annualized yield? So 100 minus 95 divided by 95 into 100 will give me yield for 184 days, into 365 divided by 184 will give me the annualized yield. That yield that you calculated with the help of a treasury bill, and treasury bill belongs to government of India, that yield can be a good substitute for risk-free rate of return in case you want to calculate risk-free rate of return for computing KE or RE in the CAPM model. So many things are there, right? So they are all interconnected somewhere. So less than 1 year, how would you calculate the yield, guys? F minus P by P into 100, or this is a slash actually. That means if they've given in months, T-bills are 3 months, then 12 by N, and if it's days, then 365 by N. F is your face value, 100, P is the price at which you bought. Okay, and this yield, where F is face value, P is price and maturity of the security. If the equation is used to compute yield of a T-bill, though this equation can be used for any security which has got a maturity less than 1 year and discounted in nature, like a commercial paper. But the yield of a commercial paper cannot be substituted for RF, because commercial papers are not issued by government or RBI. Okay, a T-bill is a short-term security issued by RBI. It is issued at discount and redeemed at par. We have 91-day T-bill, 182, and this blah blah blah. A commercial paper is a security issued by firms and organizations to meet working capital requirements. I think you can see that. Now, more than 1 year. When the calculation starts for more than 1 year, then what will happen is that there would be impact of compounding actually. So price, if you remember the equation that we did, if you remember, V0 is a C into PVA, okay, R comma N, okay, and plus redemption amount into PVIF, R comma N, correct? So guys, when I talk about a zero coupon bond, the zero coupon bond will not give you anything here. 0, 1, 2, 3, 4 and 5, okay, it will give me 100 here. Okay, so I need to discount. It will come from here to here, here to here, here to here, here to here, and here to here. And this will be your V0. So this part will not be there. This part will not be there. Only this part will be there. Which part will be there? This part will be there. Only this part. Okay. So 100 has to be discounted to 0. This is 100. Okay. And this is discounting factor. So only this part will be there naturally as per the time value of money rule. Okay. Where R is the IRR of a ZCB, zero coupon bond, like a FD, like an FD. If ZCB is issued by government, then R will be equal to RF. The duration of a ZCB is always equal to maturity. Understood? This is a very, very important. The duration of a zero coupon bond will always be equal to maturity. The duration of a coupon paying bond will always be less than maturity, because it pays coupon. And when it pays coupon, a part of your cost is getting recovered every year, not only with the help of the coupon, but the reinvestment income that you are earning on the coupon. But when the bond is a zero coupon bond, it is not paying you anything for that matter. So all the money would be recovered only on the day of the maturity, and hence the duration of a zero coupon bond will always be equal to maturity. Okay, going further. There is a question, guys, here. This is a very important question that can be asked in the paper again. Wonderland Limited has excess cash of 20 lakhs, which it wants to invest in the short-term marketable securities. Expenses relating to investment will be 50,000. Okay, the securities invested will have an yield of 9%. Okay, the company seeks your advice as to the period of investment so as to earn a pre-tax income of 5%. Discuss. What do I discuss? You have to calculate. What else? Okay, so here, guys, where is that? Okay, so if you, okay, wait a minute. As the company, I was searching for the question actually. As to the period of investment so as to earn a pre-tax income of 5%. Okay, so 5% on 20 lakhs is 1 lakh. So this is after deducting all the expenses. What did they do? 20 lakhs into 9% is your yield. Okay, into P by 12, N by 12 you can say, minus the 50,000 expenses. So after deducting the expenses, you should be getting 1 lakh. Okay, so solve for P, you get 10 months. Now break even. While calculating break even, this 1 lakh has to be set to 0. So again calculate 3.33 months. That means by the end of 3.5 months approximately, you are able to recover your 50,000. Beyond that, you are basically earning money. Okay, guys. Now coming to the next topic, term structure of interest rates. So this will be like, this is very relevant again. Term structure of interest rates. So what is term structure? So listen to me carefully. Okay. There are so many bonds in the market which are issued. There are so many companies, there are so many organizations, there is government, and then there are like supranational, that means sovereign, pure government of India. Then there are many like semi, kind of, what do you say? Not 100% government entities are there. Okay. Then there are companies which are run by government. So many organizations and entities are there. Okay. So what happens that there is something called term structure of interest rates. What is that? So let's talk only about government. So the government issues various types of bonds and debentures. It issues both kind of add-on and discounted. That means they issue coupon paying bonds as well as they issue the zero coupon bonds also. So never forget one point here, that this topic is actually based on zero coupon bonds only. I'll tell you why. So the government in India, suppose, issues bonds of 1 year maturity, 2 year maturity, 3 year maturity, and so on. Okay. So can you answer me one question here, that there are 4 bonds, government of India, ZCB1, ZCB2, ZCB3, ZCB4, where 1, 2 and 3, 4 are nothing but the maturities. Okay, that means after 1 year mature, maturity will happen, then second year and so on. You tell me the yield of, out of 4, which one should give me the highest amount of yield? One is, see, the credit rating and all are same because it is issued by government of India. Okay, but then the yields of all the 4 bonds cannot be the same, because I will not say that, because if I say that, you will get the catch. Tell me please. I don't want to give you the catch. Please tell me. Which bond will give me the highest yield? The 1 year, 2 year, 3 year, or 4th year? Rest all the things are same. Suppose if all the features are same, then only depending on the maturity, which bond should give me the highest yield? That's my question. Okay, I am asking, if you have 4 bonds. No, Pooja, no. Okay, think like this. If you have 4 bonds, okay, I think I should need to write. Without writing, you did not get the question only. That's what I feel. Okay, I'll repeat. So if you have 4 bonds, okay, the government issued 4 bonds. Okay, one is of 1 year maturity. That means one matures at the end of year 1, the second matures at the end of year 2, the third matures at the end of year 3, and the fourth matures at the end of the year 4. I am saying all the 4 bonds are same otherwise except for maturity. Yes, Harsha got the question. Which bond should give me the highest return ideally? Which bond should give me the highest return ideally? If I have 4 bonds, all the 4 bonds are same in terms of everything except for maturity, then which bond should give me the highest return? Or from which bond I would expect the highest return? 4th bond. Okay, great. So in that, why? Because if the money is standing, I am the investor standing at 0. Suppose the money in one case I need to draw, but my pen is not charged today. Yes, very good. 1, 2, 3 and 4. So the one bond will mature here, one bond will mature here. See, this is bond A, this is bond B. One bond will mature here and one bond will mature here. This is a timeline, correct? I am asking which bond should I expect to give the highest return? The 4th bond. Why? In this case, the money is very near to me now. I am not insecure about that money. I am most insecure about this money of mine, and hence I would ask for a highest return. That is called maturity premium. Okay, you have been not taught in your portions anywhere. There's some portion called in CFA. So I taught you how ROR. That's what I taught you, because there is not, beyond that it is not given in your curriculum. How did I teach you? ROR has got 3 components. One is called real RF. Okay, one is called inflation premium. Okay, the another one is risk premium. That means to say at a given point of time, these two are same for all. That means if I'm standing on, what is the day today? 17th. If I'm standing on 17th of September 2023, that means to say, guys, this part is same for all of us, because this is the rate which, if you invest with the government will give you the nominal rate of return. It will be the simple growth rate of the economy. Suppose the growth rate, the RF, you know what real RF means? It doesn't have inflation, but the rate which even government gives is inclusive of inflation. Without inflation, the rate doesn't have any meaning only. So this is called nominal RF or only RF. That means if the question is giving you RF, that means inflation is there. If no inflation is there, they will say you. Okay. Now going further. So if on this date, different entities I'm asking for different returns. For example, government I'm asking maybe like 6% return. I go to HDFC Bank, I want 8% return. Okay, and I go to you are asking like maybe 10%, something of that sort. But that these two are same for everybody. Whatever loading is happening is because of the risk and credibility of the person. Because if I give money to government, by default the money will come back, because that is sovereign. Okay, if you give money to HDFC Bank is better than retail, at least credibility wise. And if you give that money to some company or some retail or some individual or some friend of yours, the risk is all the more. So I am assuming that you are understanding. But beyond this, there are some more components which I have not taught you in your CA final curriculum. And one is called liquidity premium. That means higher the liquidity, lower the rate, return. I would be asking, if I give money to government, at any point of time I can ask my money. That is the liquidity. So there is high level of liquidity, my risk is lower. But if the liquidity is low, I would want to have more returns basically. Now there's something called, maturity premium, maturity premium. So this will have the highest maturity premium because of the highest maturity. Yes. Now, so I draw a diagram here. So when the yields, suppose the yield of this is 10, the yield of is 10.5 and yield is 11 and 12 maybe, right? So if I draw a diagram, rather a graph, where X is the maturity, okay, like 0, then 1, then 2, then 3 and 4 years, okay? And this is the yield which I have plotted here. So it can go like this, correct? So basically this is 10.5, okay, this is 10.5, no, sorry, this is 10, this is 10.5, okay, then this is 11 and this is actually 12. This is 10, this is 10.5, this is 11, this is 12. So basically this curve, okay, this curve is called yield curve. That means to say when the yields of the zero coupon sovereign bonds are plotted against their maturities, the resultant curve is called the yield curve. Who uses? If you go to RBI site, you will get that. Okay, why do we use zero coupon bond? Because zero coupon bond will reflect the purest form of yield. That means what is the rate that we are expecting our economy to grow in future. Okay, if you use the bonds of some company or some other entity other than government, the yield that you will get will not be the pure growth of the economy rate. It will be loaded with the risk component which we don't want. So looking at that yield curve, I can understand that what is the kind of movement interest rates will take in the coming future. So there are four types of yield curves. This one is called upward rising. That is normal actually, but there are three more, maybe downward sloping, then one flat, and one is humped. Okay, these three are temporary in nature. That means short-term interest rates are more, long-term are less, and the sums that you did till now, V0, C into PVA into R, N plus redemption amount, did you not see that you discounted all your coupons with one rate only, assuming a flat yield curve? Only under this concept, only this concept, guys, you are going to learn that even if it is a bond of 5 years, the risk involved in the first year coupon and the risk involved in the fifth year coupon are not same, and hence they should not be discounted by the same flat umbrella rate. Okay, that is a logic here. So this you will get only in theory. Okay, now I don't know how come this sheet has already got something. Chalo, I'll just explain a few things and then we can wind up, because then tomorrow I would not be left out with so much to teach you actually. So now tell me whether should I start the new topic or not. This will be tough and lengthy. Should I start this or not? Because this will be tough and lengthy. Quickly, tell me. If you do not want to start this, I can do a smaller topic, callable and puttable bonds quickly and wind up for today. Tell me fast. This will, I want you to do this with a fresh mind. This is a tough topic and interesting, and I would not be able to go too fast. This will take time, around maybe 45 minutes. This will take, nothing less than that. So if you want to do it very properly, we should do it tomorrow only. So if you want to study for 10-15 minutes more, I can do a smaller topic which is callable and puttable bonds for 10 minutes and it will be sorted for today. Then whatever topics are left, we can do tomorrow, not a problem at all. And if you are good enough, I can start this topic also. Tell me quickly. Actually, we can do this topic. Maybe I can make you understand and we can do the sums tomorrow or something, because the flow is already there. Let's come back. Why should I ask you? This is not the one. This is the one. Yes. I think we should start, guys. Maybe like if you get stuck tomorrow in some topic, I will be like it will be very difficult for, because tomorrow any which ways I have to finish. Look at this now. Start. Don't worry. We have a choice. Spot and forward. Spot and forward. At least allow me to explain this, because the topic is hot now. Okay. So maybe like by tomorrow you just, okay, allow me to take a call. We can continue right now here. So suppose if I draw this, okay, and like this, people get tired. It's okay. Number of years and yield. I just keep thinking, these people are finding it difficult or what, like that. It's okay, but then since it is a portion you have to study, guys, somebody has to teach, and then it is like this. My drawing is really bad, so please, not that bad, but I never, my son doesn't allow me to do his projects actually. Pooja, I will not stretch it too much, don't worry, relax. Okay, I'll just explain this whole thing and then we can wind up. Instead of taking a new topic, it is better to maintain the flow. So tomorrow what we can do, you can revise the whole thing, okay, whatever we have done till now, and then you can start with the questions of this topic. So that will be better, I feel, because if you start the new topic, you will lose out on what you have learned till now, and it has gone really well. So this is your R01, this is your R02, this is your R03, this is your R04, correct? Now what is R01? So R01 is called spot rate for 1 year. R02 is a spot rate for 2 years. Okay, R03. And what is this R01, R02, R03, R04? That 10, 10.5, 11 and okay, 10.5 and 11 and 12%. That means suppose, how can you calculate that? Suppose I tell you VA, the price of VA is like maybe 98, okay, and VB is, suppose I tell you 97, okay, and VC, suppose I say 95, possible? Again I can draw one line here, 0, 1, 2 and 3, and these are 3 bonds, A, B and C, because they will mature at the end of 1 year, B will mature at the end of 2 years and so on. So you can see the prices are going down. Why are they going down? Because with a higher maturity, we need to earn more. And that is only possible when the cost is down. Okay. Now here, can I put the formula V0 is equal to face value, okay, divided by 1 plus R raised to the power n. Okay. So if I put 98 here, okay, 100 here and 1 plus R raised to the power 1. If I want to solve this, can I not solve this? So 100 divided by 98 is 1.0204. Okay. So R will be equal to 2.04% per annum. What is this 2.04? It says that the bonds we are talking about, what are they bonds? These bonds are sovereign bonds issued by government, okay, for 1 year. The yield of 1 year zero coupon bond is 2.04%. Similarly, if I calculate for this one, why should I write the formula again and again? Not required. 97 is equal to 100 divided by, maybe I will change, don't write, I'll change the value, because if I get an answer which is lower than 2.04, I'll have to change the values because I do not remember what should I exactly do. But we can always adjust 2. Now 100 divided by 97, okay, and then I take a root. Where is that? What is happening to me today? No, it is less, guys. I can't take this, I can't take the, I can take, but in that case the yield curve that you will get will not be upward rising, it will be downward sloping, because for 2 years the rate is 2.04 and for 1 year the rate is coming 1.5% per annum, which is that way. So I don't want, it is not wrong what I did, but I don't want to take it. Okay, so let's change. Maybe I can put this as 95. Okay, and I can put this as 90. Now sounds better. Let's take 95. Why to goof up unnecessary? Good. Now when things go wrong, see, if I would have taken these values when I started only, okay, then I wouldn't have said what I said 1 minute back, that when I compute the yield of a 1 year zero coupon bond, I get 2.04. On the basis of given prices 97, when I compute the yield of a 2 year zero coupon bond, I get 1.5% per annum. That means the yield for 2 years is less. That means it is not an upward rising curve, it is a downward sloping curve. Correct, that way. So 100 divided by 95 and then I take a root. 2.6%. Yes, very good. So R02, R01 is equal to 2. Which is good. Why? Because the yield is increasing with the maturity. Then again 90 is equal to 100. Guys, can we take 4 years here? No, we'll have to take 3 years only. Wait a minute. We'll have to do 1 plus R raised to the power 3. That's a problem. Because your calci cannot do 1 by 3. I can only do. They will not ask you to do 1 by 3 on the normal calci, okay? Just relax on that part. So 100 by 90, I'll do on the scientific calci. Though people say there are methods with the help of which you can calculate. But then institute does not assume that you know that method. So just be relaxed on that part. So 100 divided by 90, I get 1.11 raised to the power 0.3333. It's 3 point. So R03 will be 3.60% per annum. Don't worry, this is an example. They will not ask you to calculate that. How can they ask you to calculate that? Your calci cannot do 1 by 3. That is the only thing that we know. Okay, relax. Now, here if I see R01 is 2.04, then R02 is 2.60 and R03, and okay, just a minute please, 2.600 is not for all the 2 years, it is 2.60% per annum, okay, percent per, that means 0 to 1 2.6 and again 1 to 2 2.6, okay. Then R03 is 3.6% per annum. That means to say 3.6 is not for all the 3 years. It is like 0 to 1 3.6, 1 to 2 3.6 and again 2 to 3 3.6. Okay. Now here guys, these are spot rates. Spot rates for 1 year, spot rates for 2 years and spot rates for 3 years. Okay. Now suppose the concept that you are wanting to study from me is called spot and forward rates. I give you a timeline here. So 0, then this is 1, this is 2 and this is 3. So this is your R01, this is your R02 and this is your R03. Can I write here that? Okay, so R01, R02 and R03. Okay, so there is an example from my side to you that I want to invest my money for 2 years. Possible? I have two choices. Either I can invest one shot at R02, that means I'll invest money at 0 and take out the money at the end of 2 years, where the money would be invested at the rate of 2.60% per annum. Correct? There is one more choice. I can invest money at R01, okay, at 2.04%, take out the money or withdraw the money at the end of 1 year, and then invest at a rate X. Invest at the rate of rate X at the end of 1 year and take out the money at the end of 2nd year. I am wanting you to calculate that particular value of X which will equate me in both the choices. That rate will be called as forward rate. Guys, are you fine, all of you? So can I write here 1 plus R01, 2 whole square is equal to 1 plus R01 and 1 plus F12. Okay, that means to say a combination of R01 and this one F12 should make me equal. This is called F12. So power has to be the same. If there is 2, so basically I tell you something very easy if you understand. Leave this example. Now, suppose guys, R01 is 10%. And R02 is suppose 11% and R03 is 12%. Okay. So either if I invest for 2 years, the total return that I get is how much? 11 and plus 11. Forget the compounding part. 11 plus 11, 22%. Okay. Out of 20, this is the method. This is what I'm going to get if I invest my money directly for 2 years. 22% is something I want to earn at the end of the 2nd year. Okay, total. Now, if I go by the other method where I invest my money for 1 year, withdraw at the end of 1 year and again invest for 1 more year, right? So if I want to earn 22%, okay, if I want to earn 22% and 0 to 1 rate is 10%, how much should I earn between 1 and 2 in order to make myself indifferent in the 2 choices? Answer please. Quickly, how much I should earn between 1 and 2? If I invest directly for 2 years, 11 and 11, 0 to 1, 11, 1 to 2, 11, 22%. Okay. So if I want to earn 22%, one shot, and if I want to create like bootstrapped, okay. So 0 to 1, I earn 10%, it is given. So 22 minus 10 is what? Very good. So if I, 12, yes, that is the logic. We are just writing for the sake of it. This is the logic. Okay, so here also guys, but you cannot calculate that way. 12% is the rate that must prevail between 1 and 2 year, so that we are indifferent between the 2 choices, and that rate is also called the no arbitrage rate, because the 2 combinations should give you the same answer. If the 2 combinations are not giving you the same answer, that means to say there is an arbitrage opportunity. Very good. So can I write here this one? 1.0260 the whole square, okay, then 1.0 F2041 and 1 plus F121. Okay, this is what they are going to ask you, nothing else. So 1.026 into 1.026 divided by 1.0204, that gives me 3.16%. okay, so this is like 1.03163 is equal to 1 plus F12 raised to the power 1. So can I say F12 is equal to 3.163% per annum? That means if you want to be indifferent between the two choices, then the rate that should prevail between 1 and 2 should be 3.163%. That also means that a combination of 2.04% and 3.163% will make me indifferent whether I invest money for 2 years one shot, or I invest money and for 1 year, withdraw the money, again reinvest. That is the meaning. So that is what they are going to ask you calculate, nothing else. So let's take one more combination. Let's take one more combination here. Maybe I want to invest money for 3 years. Okay, for 3 years. Correct. So this will be 1 plus R03 raised to the power 3 equal to 1 plus R02 whole square and 1 plus 1 plus F12 raised to the power 1. Correct. This is the combination I can create. So what was that rate? 3.6. So 1.036 raised to the power 3. Okay, 1.026 raised to the power 2. This will not be 1, 2. This will be 2, 3. Sorry. 2, 3. Because see here, where is the diagram? You have already traveled 2 years. So you want to now calculate for this period. So you want to know the rate prevailing between this one, so that you are indifferent between both the choices. Yes. Okay, so F23, so 1 plus F23 raised to the power 1. So can we do that? So 1.036 into 1.036 into 1.036 divided by 1.026, again divided by 1.026, minus 1 into 100 will give you 5.63%. So F23 should be 5.63%. There is one more combination I can do for 3 years. You know what? For 3 years, again, this will be the last thing, guys. For 3 years, again, 1 plus R03 raised to the power 3 equal to 1 plus R01 raised to the power 1 and 1 plus F13 raised to the power 2. Can you see the gap? 3 minus 1. That means, basically I mean to say this one. Give me a second. 2-year forward rate. Okay, 0, then 1. Yeah. So this I know, this I know, and I also know this one. Correct, no? I want to solve for this. So 2 years. And always look at the powers. If it is 3 here and it is 1 here, it has to be 2 to match, to have the mathematical compatibility on both the sides. So this will be 1.036 raised to the power 3. And this is like 1.0204, what I remember, and then 1 plus F13 raised to the power 2. So now how will you do? 1.036 into 1.036 into 1.036, okay, divided by 1.0204, okay, I get something, and the answer will be, you have to take a root in that case. So F13 will be 4.39% per annum. That means from here to here, it should be 4.39, and here to here it should be 4.39 in order to match this. Yes, so we are done, guys. The understanding part has been given to you completely. This is called spot and forward rate and the concept of bootstrapping. Actually, this is the concept of bootstrapping. Okay, so it is not difficult. It is very mechanical if you understand. But yeah, it has to be understood from within. You can't be like doing kind of, it is not possible to do that. Okay, I hope you get it. Okay, so This is a concept. So what we are pending with, let me tell you, we are pending with some questions that are based on this topic, and we are pending with what? Immunization and bond refunding. That's it. So we should be able to finish in 2.5 hours only tomorrow. It will not take much of time, because what I remember in the last batch, we had 2 lectures of 2.5 hours. But there are some few extra questions. So in a 7 to 10 we would be able to do it very, very nicely and comfortably. So let's leave some portion for tomorrow also, but otherwise tomorrow's lecture will become too short. That also I'm a bit worried, okay? Because if we cover too much, tomorrow's slot will be wasted then, because we would not want to start a new topic at the same point of time. Okay, thanks a lot, Pooja. Thank you, everybody. Yes. Convexity also. Yes, we will do convexity also. So tomorrow's time is good enough, Pooja, because we have crossed a major hurdle today by doing this spot and forward rates. So it will not, convexity, already I taught you 50% above only, if you remember. Repricing method and volatility method or MD method. I already introduced above only. So I do in the regular class also. I know it is a bit heavy when we start for 1.5 2 hours, but then after that it is very smooth. And once I wind up with a bond, if you go and see the sums of the institute and the exam papers, they will be very, very simple for you. Believe me, that will be very simple. It is only that you need to understand, that's it. Correct? Yeah, that, I mean, whatever is pending, Harsha, we should be able to, because any which was, I did the same sheet in the Hindi batch. Okay, 2.5 hours, 2 days, and we were able to finish it properly. So any which ways, we have covered quite a lot today. So by tomorrow's lecture, we would be done with everything. Any which ways, there are only 3-4 people who are like interacting. Rest of the people are not even interacting. So maybe they do not have doubts. In the last batch, there were a lot of people. So doubts were also more. Still, we were able to finish in 5 hours. So relatively, if you see, we are investing more time in bonds in this batch. So just be relaxed. Okay, so try to finish and go and study audit, go and study law, go and study something else. SFM will be taken care of. Bye bye. So tomorrow 7 o'clock in the evening we are meeting. All of you are fine? Bye bye. Bye bye. 7 o'clock, 7 p.m. tomorrow evening. Great. Bye bye. Please like, please comment, please subscribe to my channel. Okay, I'll say daily. My team has requested to say that. Please like, subscribe, okay, and comment on my channel, comment on my videos, and also join me on Instagram. Thank you. Bye bye.